For the November TRG meeting, we have 4 issues to discuss today. And before we get started, I want to welcome our colleagues from the IASB. I can see Henry, Raghava, Stephen, and I understand Gary may be joining us as well. We don't see him on screen if he's...
That's right, Jim. He'll be here very shortly.
Okay. Thank you. And please feel free to participate in any way you want in the discussions. Just raise your hand or flip a tent card like we do here, and we'll make sure to get you incorporated in the discussion as well. Joining us today in substitution for Brett Cohen is Angela Ferguson. Welcome, Angela. And then we have a number of members who should be joining us by phone. Let me just make sure that you're there. Alan Cohen?
Yes. Here.
Great. Mike Wood?
Here.
Jeff Bryant?
Here.
And Jay Hansen?
I'm here.
Anyone else on the phone? Those participating by phone, I think we've already sent out instructions. If you want to get in the discussion, just send an email to Dylan Jones. Dylan will turn his tent card up as the placeholder to get you involved in the discussion. So, Dylan, if you're just flipping your card up all day, you may be busy. With that, let me turn it over to Kramer. Kramer's going to give us an update on the standard setting activities.
Thanks, Jim. So the TRG has met 7 times since the issuance of the new revenue standard, with this being our 8th meeting. The staff have received a total of 108 TRG submissions to date. After the completion of this meeting, there will be no remaining TRG submissions to be addressed. The majority of the implementation questions discussed at the prior meetings have been resolved at the meeting without any further action needed. However, standard setting has been required on a few of the issues. Earlier this year, the FASB issued 3 final accounting standard updates which provided clarification on issues raised by the TRG. The only remaining standard setting in process relates to the FASB's recurring technical corrections and improvements to the codification. Since our last TRG meeting, the FASB issued 2 proposed updates that both relate to technical corrections and improvements to Update 2014-09. The proposed updates include several items suggested by TRG members at previous meetings. The board plans to issue a final update before the end of the year that includes the items from both of the proposed updates, except for the amendments that were proposed on the guidance on pre-production costs related to long-term supply arrangements in subtopic 340-10. In the May 2016 proposed update, the board proposed to supersede the guidance on pre-production costs related to long-term supply arrangements in subtopic 340-10. Due to stakeholder feedback that was received immediately before the board meeting, at the October 2016 board meeting, the board decided to remove the amendments related to this issue from the current technical corrections and improvements project. The board did not want to hold up all of the other amendments to address this one issue, and the staff plans to separately perform additional research and outreach on the topic. The staff reminds stakeholders that the FASB has an ongoing technical inquiries process where stakeholders can directly contact FASB staff members to discuss questions. While TRG submissions have been on the decline in 2016, we have seen an uptick of technical inquiries over the past 6 months. Generally, these questions are not broadly applicable to stakeholders and may relate to specific industries or fact patterns. In cases in which we think that inquiry could be informative broadly, we have made sure others are aware. For example, the topic we will discuss later today on overtime revenue recognition is an area in which the staff received a few technical inquiries, and so we thought it might be helpful to discuss the topic at this meeting for educational purposes. Also of note, in September, the FASB and IASB held a joint webcast to discuss implementation activities, disclosure requirements, and transition for the new standard. The webcast is available for replay on the FASB website. The FASB and IASB continue to work closely together to share information about implementation progress and to seek input from each other on implementation questions as they arise from stakeholders. As mentioned earlier, the TRG has received 108 submissions, resulting in 59 memos that have been discussed by the TRG and are posted on the FASB website. The staff is in the process of compiling a quick reference guide to simplify the navigation of the memo content. That file is designed to organize the various issues into steps of the revenue standard where issues would be appropriately considered, and the file will also group TRG memos by issue. The staff believes that this will provide some useful context in helping stakeholders understand these issues going forward. To be clear, there is no change in the content, only an organizational improvement. Finally, the staff would like to thank the TRG members for their input outside of TRG meetings. Many of you are generous with your time and thoughtful with your feedback, and we appreciate the collaboration. And with that, I'll turn it back over to Jim.
Thanks, Kramer. I also want to welcome Wes Bricker from the SEC as our observer. Wes, let me just turn it over to you. Any thoughts you might have?
Sure. Thanks, Jim. Just a word of appreciation as well to all of the effort that goes into preparing and participating in transition resource group meetings. It's certainly important from the staff's perspective regarding the emphasis of good application of the new standards. I thought I would also provide a quick update in terms of the SEC's review of its own guidance, and that is as follows. In terms of our existing guidance, we continue to review our current SEC guidance, including SAB Topic 13, prior accounting and auditing enforcement releases, particularly the Parnes decision in AAER 108, which describes bill and hold from the Commission's point of view, and then finally the vaccine release, among others, which continues to be relevant to existing revenue reporting before transition to the new standard. The SEC staff will continue to review the applicability of that guidance with a view toward providing clarity on the future of the guidance in the near term. We did update historical SEC observer comments earlier this year during the EITF meeting on March 3rd, 2016. So I would refer to those prior comments in which we clarified that those prior comments of the staff would not be applicable after the effective date of the new standard. In terms of staff decision-making regarding revenue, our starting point is clearly the new standard, and our evaluation is in relation to the new standard. And therefore, in terms of any new guidance, what we've focused on to date has really been the transition disclosures to the new guidance, and to that end, we communicated our views about both quantitative as well as qualitative disclosures that entities should provide during the transition period in an SEC staff announcement at the EITF meeting in September 2016. So just a quick update, Jim, in terms of our activities.
Thanks, Wes. And at the end of the meeting, we'll give time for the TRG for any comments, questions, or a discussion of other open issues. But in the interest of time, let's jump into the first agenda paper. Dan, I think you're going to
over here.
Oh, you're going to tee this one up on capitalization and amortization of incremental costs.
Yep. Thanks, Jim. And there's two questions in the paper. I'll tee them up separately. So Memo 57 addresses questions about the recognition and measurement of incremental cost of obtaining a contract and estimating the period of amortization. The TRG previously discussed questions related to incremental cost of obtaining a contract at the January 2015 meeting. Some stakeholders have informed the staff that there are different interpretations of that discussion. Question 1, which costs to obtain a contract are incremental? Paragraph 340-40-25-1 requires an entity to recognize as an asset the incremental costs of obtaining a contract with the customer if the entity expects to recover those costs. Incremental costs are defined as those costs that an entity incurs to obtain a contract with the customer that it would not have incurred if the contract had not been obtained. Some stakeholders have questioned which costs to obtain a contract are incremental. In particular, some have expressed concerns that the term incremental could lead to broad interpretations of the types of costs that would qualify to be capitalized under the new standard. In the staff's view, a way to think about the incremental cost guidance is, would an entity incur the cost if the customer or the entity decided, just as the parties are about to sign the contract, that it will not enter into the contract? If the cost would have been incurred even though the contract was not executed, then they would not be incremental costs. However, if the costs are incurred only as a result of obtaining the contract, then they would be incremental costs. Memo 57 includes examples that illustrate incremental costs to obtain a contract. For instance, example 4 describes a scenario in which commissions are paid to multiple levels of employees for a successful contract. In the staff's view, if the employee's commission results from obtaining the contract, then each of the separate employee commissions should be capitalized. In other words, the staff thinks stakeholders should focus on whether the entity has an obligation to make a payment to an employee as a result of obtaining the contract. So with that, I'll open it up to the TRG for discussion on question 1.
Thoughts? Oh, Allison?
Thank you. Good morning, everyone. First thing I wanted to do is actually just to say thank you to the staff for the time and the effort that you've put into thinking about this question. Dan, as you mentioned in the tee-up, the question first came before the TRG back in January of 2015, and we're back revisiting the topic again here in November of 2016. So appreciate the staff's willingness to conduct outreach and to talk to various constituents who've had a number of questions about this area despite that prior TRG discussion. In particular, as we're thinking about issue 1 and the interpretation of what it means to be incremental, it's difficult to argue with the staff's interpretation based on the words in the standard. I think certainly some of the questions that we've been hearing in practice and the reason why people are looking at the words incremental and wondering what does it mean is because legacy U.S. GAAP for companies that were capitalizing these sales commissions focused on capitalizing those costs that were direct and incremental. And so an example of something that might be direct would be if you have a tiered commission structure where you have various levels within an organization receiving a commission upon the signing of a contract with a customer. It could be that the company would interpret direct as being only those individuals who have actually touched the customer directly or been involved in direct discussions with the customer. So under today's practice, those might be the types of costs that would be capitalized. But I think, as you noted, especially with example 4, it appears as though that's going to be a wider bucket of costs. And while I think companies in practice are anticipating that that could be the interpretation, it is very helpful to have this discussion to finalize that. Because some were thinking, how is that possible that we have current GAAP today, and that wasn't really the intention of the board to be driving towards a model where you would be capitalizing potentially significant increases to the capitalized cost that exists today. So again, thank you for the information. There's nothing that I can really do to argue against the point, and just wanted to make sure that it was clear and that everybody understands that this interpretation likely will result for many companies that capitalize today in the United States to be capitalizing more amounts on their balance sheet.
Angela?
Thanks. Agree with a lot of what Allison said. I think that this is helpful, and it is hard to argue with the interpretation of incremental, but I do think it's going to be a little bit broader than some were thinking. One question that we had, just to clarify, you had the discussion of the bonus that had the multiple factors and thus would not be considered incremental, and I certainly do agree with that analysis. But I assume if you had a bonus, like an executive bonus pool that was actually based only on sales, like a sales target or threshold, that would get picked up as incremental based on the way you did your interpretation in the paper. Is that a fair assessment?
I think that's fair. If the bonus were paid almost as a deferred commission, so rather than paying it upon signing of the contract, but it's paid at the end of the year based on the performance of all the contracts, then I think it could meet that definition. To the extent there's a discretionary element or other things that get factored in, then that, I think, could sway it the other way.
Okay.
I agree with Dan, but I would be cautious about the higher up in the organization you get. Is this really just solely related to securing a contract? So if I obtain a contract, the top person in the organization actually makes another $5,000 a year. I can imagine that can happen in some cases, but I'm not familiar with that many cases where, particularly at public companies, the top people actually their comp is directly tied to obtaining or not obtaining a contract. seems like from what we've heard, it's more, there's many factors that would go into a bonus, or call it what you like, one of which is something related to sales or sales growth. But none of this changes what Dan says. I'm just saying I would be cautious about the higher up you get in an organization, challenging whether that bonus payment or commission or whatever it happens to be called at a company is actually directly related to securing a contract or not securing a contract.
Right, but it could be like a pool, obviously a pool of contracts, not just a.
Yep.
Yeah. Okay.
Yep.
Thank you.
Marty?
Yeah, thank you. And thanks for the papers. I thought they were excellent as always. But I had a similar question as the last one, in that there's some words that are used in the text of the paper here that aren't in the standard itself, such as on page 9 of 18, and it says the stakeholders should focus on whether the entity has an obligation to make a payment to the employee as a result of obtaining the contract. The words in the standard aren't as strong as have an obligation to make it. It just says costs that it would not have incurred if the contract had not been obtained. So I could imagine in many cases the bonuses are not necessarily an obligation, but the bonus could be, in many companies, very closely tied to increased sales and more contracts therefore having been signed. And in some of the examples it's written as if there's just a company with a contract is a periodic thing. Many companies have thousands of contracts written daily, and so it may be tied more to a bonus pool based upon increased contracts, more sales. And so I could see more cases where, at least based upon the words as written in 340, 4025, 1 and 2, it just seems that bonuses could be, if the bonus pool is largely tied to increased sales, capitalizable, and the word that it has an obligation to, the determination of that bonus pool may be made at a later date based upon sales. So I just assume a bonus pool can work as long as at the end of the day it's linked to sales.
I think that's right, Marty. I think the obligation to was trying to clarify the notion of it relates to the contracts itself, not some other thing. It's obtaining contracts plus getting a superior rating for customer satisfaction or multiple factors, as opposed to it results from the sales transactions or the revenue transactions.
One thing you said, Marty, I think actually highlights a very good point to make, which is this guidance does not change whether or not an entity has an obligation. It doesn't impact the liability side. And so from the staff's perspective, whatever judgments and estimates people are making today to determine whether they should have a liability for this compensation, they should continue to follow that. And nothing in the staff's paper should be construed to change that. This paper is just about, once you book the liability under existing GAAP, what do you do with the other side of that? And what you do with the other side of that is an area where there will be a change for some companies. But the liability itself, there shouldn't be.
Mark?
Yeah, just quickly on that point, I think we were looking at paragraph 23, and I assume, and maybe now those would not be capitalized when you say, for example, it could be this. So if it's essentially the way we read that is if it's not avoidable, if it's avoidable because of something else, then you wouldn't capitalize it. Is that how we should take that, or?
You wouldn't capitalize it under this guidance because it's not an incremental cost of obtaining this contract.
So like an example 3 where it says the employee no longer, they don't need to be there. If the employee did need to be there, that would change the answer.
That particular question is, to me, is a difficult one. If the only thing that needs to happen is that the employee is there. If there are other things that need to happen, which I think is what you're referring to in paragraph 23, about the employee needs to sell some add-on services, or the customer needs to complete a survey at the end of some interim period and provide a minimum rating that shows they're satisfied. In the staff's view, that would be clear that that's something beyond an incremental cost. If it's a circumstance where it just says that the employee has to be there, I would want to know more, meaning does it say the employee has to be there and they have to have a minimum employment rating, or the employee has to be there and they have to perform, in accordance with whatever HR policies exist to get them a top rating, and then they would receive the bonus? That might impact the conclusion, because the key is you're trying to figure out, is this bonus payment solely related to obtaining this contract? And I can envision a circumstance in which a company would say, okay, you get 2% of the commission now for entering into the contract, but we're going to try to figure out a way to make sure you perform well to get the second half of that. And if it said you have to maintain a level rating of 5 out of 5, I'm not sure that would be, depending on what the exact circumstances are, but I'm not sure you'd say, well, is that really just related to this contract? It sounds like you need to show up every day and do an outstanding job. And then if and only if you do that, then you get the other 2.5%.
And I would urge some caution in trying to precisely define every fact pattern in terms of what incremental means, because that term is used in existing GAAP, and that is not an intersection of the direct guidance. That seems to be a direct question as to each fact pattern, what is incremental. I think we have that guidance in other areas of GAAP, dealing with DAC, dealing with costs associated with originations of financial assets, and so ask you to think about how have you interpreted those questions. They must come up in other fact patterns. People must have worked through these or have reasonable conclusions, and whether or not we want to go through dozens of iterations that may impact interpretations in insurance or financial instruments, I don't think the board had any intent to change reasonable interpretations in those pieces of literature. So I think to some extent practice must have dealt with these questions. Scott?
Along the lines of last two things Cullen and Jim said, talking about being reasonable and looking back to when you accrue the liability, I had the same question that Mark did. And well, what if the person just has to stick around another 6 months to get the second half of the commission? And I guess I resolved it in my own head by saying, well, the question is really, when do I record a liability to pay the second half of that commission? If I conclude that the requirement to stick around for 6 months is essentially perfunctory, de minimis, non-substantive, I'm going to book the liability up front when he makes the sale. And in that case, I would think it's incremental. I've determined that it's solely related to making the sale because the other criterion is not substantive. So I would go ahead and include it as incremental cost. If, on the other hand, I decide that the requirement to stick around 6 months is substantive and therefore I don't have a liability to book yet, well, then it seems like I've concluded it is not solely related to making the sale, so it would not go in the pool of costs to be capitalized. At least that's the way I kind of resolved it in my head and figured we could probably deal with these things in practice.
Allison?
I was only going to add the exact same point. I was thinking about service vesting conditions and so forth, that if they are substantive, I would have thought that means that the commission is linked to something other than just the sale of the contract. And so if you're accruing the liability for the compensation expense over time, I wouldn't have thought that would be an incremental cost.
Anyone else? Folks on the phone? Folks in London?
Okay. We'll move to question 2, which is how should an entity determine the amortization period for an asset recognized for the incremental costs of obtaining a contract? Topic 340 states that an asset recognized for the cost of obtaining a contract with a customer shall be amortized on a systematic basis that is consistent with the transfer to the customer of the goods or services to which the asset relates. The asset may relate to goods or services to be transferred under a specific anticipated contract. The basis for conclusions in Update 2014-09 explains that amortizing the asset over a longer period than the initial contract would not be appropriate in situations in which an entity pays a commission on a renewal contract that is commensurate with the commission paid on the initial contract. In that case, the acquisition costs from the initial contract do not relate to the subsequent contract. Stakeholders have raised concerns about an amortization period that extends beyond the term of the initial contract and requested clarification on questions regarding the estimated amortization period. In the staff's view, an entity will need to evaluate its specific facts and circumstances to determine an appropriate amortization period. The use of judgment in estimating the amortization period for an asset representing the cost of obtaining a contract is similar to the use of judgment in estimating amortization period for other assets. The key consideration is whether the capitalized incremental costs relate to goods or services that will be transferred only as part of the initial contract, or if the costs also relate to goods or services that will be transferred as part of a specific anticipated contract. The staff does not think the new revenue standard would require an entity to amortize the asset over a period such as the average customer life when renewals are anticipated, but rather that an entity should use judgment in its determination of the goods or services to which the asset relates, which might include the goods or services to be transferred during the term of anticipated renewal contracts. The staff would also like to clarify a question about the evaluation of whether the commission paid on a renewal contract is commensurate with the commission paid on the initial contract. Stakeholders have raised questions about how an entity should interpret the term commensurate when determining the amortization period. Some stakeholders have informed the staff that they interpret language in TRG memo number 23 to mean that an entity can consider whether the commissions paid are commensurate with the level of effort to obtain the initial and renewal contracts. For example, assume the initial commission rate is 10% and the renewal commission rate is 2%. Those commissions paid for the initial and renewal contracts could be commensurate with the level of effort of obtaining each contract because the sales group that obtains a new contract spends more time on that contract than the team spends on the renewal contract. Under this interpretation, the contract renewal would not be included in the amortization period of the asset from the initial contract. The staff does not think that interpretation of using level of effort to determine whether a renewal commission is commensurate is consistent with the guidance in Topic 340. In the staff's view, the question is not whether a commission is commensurate with the level of effort. The question is whether the renewal commission is commensurate with the initial commission, and therefore whether the initial contract commission relates to only the initial contract or to the initial contract and future contracts. With that, I'll open up question 2 for discussion.
So it seems like there might be a little interest in this issue. I think we had a record number of submissions on this question. Brian?
Yeah, I wanted to ask a question on paragraph 32C. There's a sentence in there that says the staff thinks using an amortization period equal to the average customer term is a reasonable application, provided that the facts do not clearly indicate that the average customer term is inconsistent. So those words do not clearly indicate. Is that like creating a rebuttable presumption that average customer life? Because I guess I wouldn't have thought that. Because if you think of average customer life, that means at the end of that term, half the customers are gone. So if you're thinking of, well, I should amortize it over the period I expect to get probable economic benefits, if I lost half the customers, that probable being at like 80% would suggest to me that maybe average customer term might be a starting point, but certainly should probably not be any more than that, but it might logically be less than that in just thinking about it in terms of probable cash flows to support an asset on the balance sheet.
We didn't write that intending for it to be a rebuttable presumption. The thought was, average customer life is a spot where you would have objective evidence of the term, and in some arrangements, service arrangements, where the service is not changing over time. An example could be like a health club or something like that type of arrangement where the services aren't changing. We think that using average customer life where you have that objective evidence would be a good starting point. You'd have to look to other facts and circumstances, but we wouldn't default to starting there as a rebuttable presumption. And to your point on the you have half the customers who would have lapsed already and another half carrying on. You'd probably also need to think about kind of what's the deviation between when customers come on and come off as well.
Okay, and then I have one other question. It seems that some of these notions are anchored in around amortization, by analogy to 350/30. In that, it talks about, you got to come up with a reasonable method matching the economic benefits, but at the end there's a sentence that says, well, if you can't reasonably or reliably determine what those are, then you can default this straight line. Do you think this is an area where just defaulting this straight line would be appropriate? Because presumably, to capitalize the asset in the first place, you had to identify, I have some anticipated contracts, right? And if you have thought about that, then theoretically what those economic benefits are, which I would think you would generally want to try to match the amortization against those. To give you a what-if scenario, if I'm a software company, I sell software for $10 million in PCS for $2 million, and I think they'll keep the PCS, it's renewable year to year, and I think they'll be a customer for 5 years, then I'm at $10 million up front of revenue recognized and $10 million over 5 years. I wouldn't think I'd take that commission and just go, I can just amortize it over 5 years straight line. Does that make sense? Or, this paper doesn't really address amortization pattern or methods. And that's kind of, once people get past, I got to capitalize this.
Right.
And the next question is going to be, well, now how do I amortize it?
Right. I think if you look at the language in the standard is around using a systematic basis, which would be consistent with, the approach in Topic 350. So where you had something like that software example where the revenue starts high and it tapers off, I think you would need to think about whether the amortization period ought to be reflective of that.
So what would somebody do today with that?
Well, I think there's
some do and some don't. Some do straight line. So your argument would be if you're doing straight line today, that might not have been systematic and rational.
Well, I think I would say a lot of clients today expense commissions is incurred. At least in the technology space, the primary capitalizers of commissions are SaaS companies, so they have that nice, beautiful straight line revenue recognition. In the software space, at least the circumstances I'm aware, they're amortizing in proportion to revenue recognized.
Scott?
I was just going to make 2 points. I wasn't particularly comfortable with the average customer life reference because it seemed to me that the average customer life would not be consistent with amortizing as the revenue comes in. In fact, it seemed like straight line over the average customer life would be wrong to me, except you could make the argument that on a pooled basis, you're not expecting it to be materially different, because I think the requirement is that you amortize ratably with the revenue. And unless you expect the revenue to come in straight line, you can't amortize straight line. So I wasn't sure I was too comfortable with that comment about average customer life would be okay. There are some situations where I think straight line over the average customer life would not be okay, and that you'd have to do something more difficult than that. I mean, that's why people would like to use that. The other thing, though, that I was trying to work out in this paper, you've said that if there is a commission on renewal that's commensurate, then you're not going to include renewals in the amortization of the initial asset. I get that. And then if there isn't a commission on renewal that's commensurate, use judgment, I think is what it says, to figure out what to do. Hypothetical, let's see if I'm figuring this out right. company pays a sales commission on the initial contract. For renewals, they have a group that deals with customer service on a regular basis and also is charged with renewals. That group's compensation does not include commissions on renewals, but rather includes a bonus that is based on, amongst other things, success in getting renewals, but also based on other customer service related activities. And therefore, there are no incremental costs of the renewal. My thought was that in that situation, if you actually thought that the level of effort needed to get the renewal was similar to the level of effort needed to get the original contract, then you wouldn't amortize the sales commission on the original contract over any renewal period, because the only reason there isn't a commensurate commission is because you've chosen to pay these people who deal with renewals differently. Is that a fair thought process?
I think, my view on that one is you'd have to look at, you wouldn't have a renewal commission, as you said, but you'd have to look at that initial commission and whether it relates to services to be provided under those renewal contracts.
Well, the commission doesn't say it's related to services, and it's how to make that judgment that I think some companies are having trouble with, and I've typically pushed back when they've asked me the question and said, "Don't you know what you're paying a commission for? What do you think? Do you think that you're paying this person in anticipation of renewals, or do you think that you really compensate other people for the renewals because that's the way your business works?" And typically the answer is, well, never really thought about it that way. We pay commissions based on what we need to keep our salespeople who are good. We don't do an attribution. We figure if we don't pay commissions this high, our good salespeople are going to leave.
Yeah, although I think your first point is the right one. At some level, you must have some intuition as to why you're paying. And I get that it may not be written down that it's precisely for this period, but you would think that's a good starting point. I would think you might also have similar questions if you had an intangible in a business combination. That intangible is certainly going to be impacted by the value of that intangible, by the amount of commissions that it takes to keep the asset in place. All of those same considerations must seem to be relevant to then how you might amortize that intangible, because presumably if it was a more sticky customer, the commissions might tend to be lower on renewal and impact life. If it's a less sticky customer, the asset value may be less and impacted by the fact that you have to pay continuous commissions to keep it in place. So I don't think this is, I think it's a useful discussion, but I don't think it's entirely a new concept. I think you have the same issues in PP&E with the interaction of maintenance costs. I think you could view this as just asset maintenance, and how does asset maintenance impact the period of amortization? And I think there are judgments made there all the time, although we could go down the path of component, depreciation. We don't. Allison?
Thanks. Actually, Jim, you made most of my points. I was going to say that the reason why the large volume of questions has been coming in, because I think as companies were concluding that level of effort wouldn't be an appropriate part of the analysis for figuring out if your renewal commission is commensurate or not, the questions then turn to, well, what's the amortization period? And the range being between contract term and average customer life, which for some companies could be, double digits, 10, 15, 20 years, which may not really make a whole lot of sense for amortization when you're thinking about a commission that's paid to somebody up front. So where we're starting to hear the discussion turn, Jim, is along the lines of what you were just articulating. Companies now looking towards thinking about, well, if we're obtaining a customer and it's the customer relationship that we're really thinking about, are there factors or characteristics about that customer in the methods that we would use, like in a business combination or something other, or PP&E, not that that's related to customers, but just thinking about, we come up with depreciation methods, we come up with amortization methods for other types of assets, and maybe that type of approach of thinking about the period of benefit might be the right way to go, that it isn't intended to be the super precise, absolute matching of the amortization period for a particular contract. I just sharing with you the feedback that I've heard, that I suspect that that's where some of the company's analyses will start to be turning.
I like the way you articulated. I think even the customer life, of course, Dan, I think you said is an objective piece of evidence. Well, you can determine prior customer life, but of course the next customer life may not be objective. Maybe you can get an estimate for the pool, but I think all of this is sort of trying to estimate a pattern of benefit. Angela?
I guess just to what I have that maybe is incremental, I guess maybe thinking about it a little differently than Scott and Brian articulated. We were hoping that in many cases average customer life would be a reasonable measure and would keep this from being kind of an overly complicated analysis for companies. So just wanted to make that point, that we were hoping that would almost be somewhat of a safe harbor. Safe harbor is maybe not the right term, but in many cases could be viewed as reasonable without someone having to go to big lengths to support why they weren't using something different than customer life.
Yeah, we read this and we had pretty good discussion around it, and I've also talked with others. I mean, the way I'm reading this, there seems to be a pretty broad runway on. I like Allison said, is it the contract life or is it the customer life? It's somewhere in between, is what this is saying, and I don't know whether it would be helpful to provide. I mean, we were like thinking through, like, does the size of the commission in relation to the ongoing contract value, does the maintenance that's involved for keeping that customer, how sticky are they, what do we have to do to keep them, the sort of that level of effort. You mentioned in here, does the product change over the customer life, and that's important. Laying some of those factors out, and I'm sure there's others, would probably be helpful. I know we've talked about a few here today. Jim just mentioned some, Scott mentioned some. I don't know, putting in the minutes those kind of factors for people to consider to try to narrow the runway a bit. I think there's concern that if you amortize this, the asset too long, you say customer life, you're going to be challenged. If you amortize it too short, you're going to be challenged. If there's things that people can point to say, here's how we applied our judgment, that like you're talking about, to help, I think that would be good. Otherwise, as it's worded right now, I think you will see a pretty broad diversity in how people amortize these, some shorter, some longer. But I would think putting something in the minutes with all the factors that we're talking about here would be very helpful.
Dylan, we have somebody on the phone?
Alan Cohn has a comment.
Yeah, hi, it's Alan. I was going to actually make similar comments to what Mark just mentioned, in that I don't think the average customer term that's written here should be like a bright line. There are various factors where someone might amortize the cost over a shorter period than the average customer term, or it very well could be the average customer term, but putting in some color and some factors people should be looking at would be helpful.
I think we can think about that in terms of educating people about a process that might be a reasonable set of things to think about. Obviously, we're not going to amend the standard through the minutes, but I think we can probably think about, here's some reasonable things to think about in making that assessment.
Yep, that would be helpful.
Others? Anyone else on the phone? Anything additive in London? Okay.
Nothing here, Jim.
So I think on the first issue, big takeaway is whether or not we could add something to the, I think the thought process we've outlined in the paper, I heard on issue 1 is helpful. We can get that into the minutes. On issue 2, I think an understanding that it isn't a default necessarily to the customer life. You have to think about the period of benefit, but whether or not we can be successful in getting some of the criteria that one might think about without making that, an exclusive list. We'll see if we could do that.
Okay.
to me, as we think about how we would do that, it'd be helpful to know what are the things that people think about today to figure out what the amortization period is for intangibles and other PP&E. And I suspect we would say you think of the same things. I mean, this isn't more complicated than that, and there isn't more gap, on those things generally than this thing. So I'm not sure we would write down anything more than the types of things people think about today. For example, when amortizing a customer-related intangible in a BizCom. All that's to say, don't expect a panacea. We'll probably just be writing down the things that you already think about today.
Actually, I think even writing that down would be helpful, because I think there's plenty of companies that are thinking this is a very different asset than those other assets, and therefore, there must be some different rules or different things to think about. And just reminding people that, hey, you got lots of intangibles on your books where ongoing activities affect how long the intangible will be useful. So, do the same kinds of thoughts that you've done on those. I think it's helpful.
Okay.
There could, this is Alan again, there could also be something different in this case than a normal intangible, in that the sales commission itself could be just so small that relative to the overall contract, that just amortizing it over such a long period just would not make sense, or the average customer period just would not make sense, which I guess you would not normally think of when you have a normal intangible asset. Here you're dealing with a sales commission.
Alan, I think that could be right. You could look at a commission paid up front and say, look, and I think this gets partly to Scott's point of people having an understanding of what the commission was paid for, that you say, look, it doesn't even make sense that 10 years from now I really have the same asset as that which I paid that commission for. The nature of my ongoing performance really tells me it was something subsequent to that. But I think it's going to be hard to capture this in minutes other than broad strokes of things you might think about. Otherwise, I think we risk standard setting in an area where the board hasn't prescribed single methodologies.
Yeah, that's fine.
So the second issue, Dan, I think, or the second set of paper is also you?
Yep.
Okay.
So Memo 58 is on licensing and minimum guarantees. It addresses questions about the accounting for a sales-based or usage-based royalty promised in exchange for a license of intellectual property that includes a minimum guarantee. Stakeholders have questioned whether and how a guaranteed minimum impacts the application of the recognition constraint for a royalty on a license of intellectual property. The minimum guarantee issue arises because Topic 606 includes a recognition constraint for royalties, but that recognition constraint does not apply to fixed consideration. In effect, consideration in the form of a sales-based or usage-based royalty with a minimum guarantee includes elements of both fixed and variable consideration. Question 1 addresses minimum guarantees for symbolic intellectual property, and Question 2 addresses minimum guarantees for functional intellectual property. I'll start with Question 1 and then we'll follow up with Question 2. So Question 1 is, how does a minimum guarantee impact the recognition of sales-based or usage-based royalties promised in exchange for a license of symbolic IP? The staff views the question for symbolic IP to be about the recognition of revenue in Step 5 and selecting an appropriate measure of progress. Similar to other overtime performance obligations with variable consideration, this analysis can be challenging and requires judgment. Stakeholders have reported two broad approaches for the recognition of royalties for symbolic licenses with a minimum guarantee. Under the first approach, which is summarized in views A and B in Memo 58, an entity would estimate the total consideration and apply an appropriate measure of progress to recognize that revenue as the entity satisfies the performance obligation. An entity could apply the practical expedient in paragraph 55-18, which is otherwise known as the P times Q practical expedient, and thereby recognize the royalties as the customer's sales or usage occurs. This approach would be appropriate if the royalties correspond directly with the value to the customer, and this is summarized in view A. Alternatively, an entity might estimate that total consideration and apply an appropriate measure of progress, such as time elapsed, to recognize revenue over the term of the license, subject to the royalties recognition constraint. This is summarized in View B. The second broad approach is summarized in View C. An entity would apply a measure of progress to the minimum guarantee or the fixed consideration and only recognize the royalties when the cumulative royalties exceed that minimum guarantee. Under View C, the royalties would be allocated to the periods to which they relate using the series allocation model for variable consideration. In the staff's view, the views described in Memo 58 are reasonable interpretations of the new revenue standard for licenses of symbolic IP with a minimum guarantee. The new standard permits judgment in selecting an appropriate measure of progress for overtime performance obligations with some boundaries. Some of those boundaries that stakeholders should consider for symbolic licenses include the royalties recognition constraint, the criteria to apply the practical expedient in paragraph 5518, the criteria to apply the series recognition model, and selecting an appropriate measure of progress in accordance with paragraph 25-31. With that, I'll open it up to the TRG for discussion on question 1.
So Dan, just maybe before we start the discussion, I think you talked about using judgment, and I think, as I think about this, and I'll ask you a question at the risk of you telling me, no, that's not how you think about it, but I think it is the judgment is to see whether you're in the boundaries that you outlined. Do you have something that directly conflicts? But then when you get to the 3 views, it isn't that some application of judgment will narrow you down then to the single one that is always right. Within that, we think, even though they result in different attribution patterns, that any of the 3 might be, at least in the fact pattern illustrated, that any of the 3 might be an acceptable choice. Is that a fair way to?
That's right. I think there's judgment to get to the 3. And the one thing I would say on views A and B is, what you would, we kind of put this notion of you have an expectation that you're going to exceed the minimum. And at least in respect to View A, where you're applying the expedient, it seems like you'd want to have that expectation going in. Otherwise, applying that expedient may not result in a pattern of recognition that makes sense.
But I think as we illustrated that fact pattern, if you assume that, we'd say A, B, or C would be an acceptable accounting policy choice.
Right.
Allison?
Thank you for saying that, Jim. That's helpful to hear. One question that I had is in part because questions around the royalty constraint there has certainly been some confusion since the standard was first issued as to whether the royalties recognition constraint really is a recognition constraint, which it has subsequently been clarified, or whether that means that a company does not have to estimate the royalties. I think some were thinking that just kind of full stop, that you would never be required, nor would you be permitted to estimate the royalties based on the guidance in 55-65. I think the subsequent clarifications through the ASU have helped with that. And so I just paused really quickly on the paper in paragraph 12A, which links then to views A and B in the paper. So view A is, as you described it, the P times Q. View B indicates that an entity could estimate upfront and then apply a measure of progress based on what they think is appropriate for that symbolic IP. Because view A is P times Q, that doesn't really sound like there would be estimation involved, whereas paragraph 12A suggests just by the introduction there that there is an approach where you would estimate the total consideration and then apply a measure of progress. And the reason for asking is, as companies are thinking about their internal control procedures and trying to establish places where they need to have estimates and then review controls on top of those estimates, if an entity thought it was appropriate to apply a view A and that they had internal controls to deal with just the expectation question about whether you're going to exceed the minimum guarantee, it feels as though that should be sufficient, that you're not needing to, by theory, go through and estimate the total amount of the royalties. And I just would like to make that clear as companies, again, are getting their internal control systems put in place for implementing this part of the standard.
As I think about those 2 views, I think view B is a more precise number because that is the basis for recognition. Whereas view A, you're setting an expectation that using 5518 is an appropriate measure of progress. and in effect, you're taking royalties as they're earned as the recognition, because it would result in the same pattern of recognition if you were estimating those royalties over time. So I think that the estimation is maybe a little bit different under View A. It wouldn't necessarily have to be a precise number, but there would need to be enough there to, make sure that that is an appropriate model to use.
Enough to make sure that you do, in fact, think that you're going to exceed the minimum.
Right.
Or not. Okay, thank you.
Which presumably in some fact patterns might be very clear depending on the royalty, and in others might require more work.
Correct. I would think so.
Mark?
Yeah, thanks for putting this together. It's helpful. And I was going to say the same thing about View A, but in View B, I was struggling a bit with it just to make sure I understand it right. The $8.25 million in that example, that's the constrained amount. Is that right? This makes it sound very simple because the 8.25 never changes.
Right.
But theoretically, if it was only probable that you were going to get, say, 5.25 million, your estimate might have been 8 million, but you assess that it's only probable that you're going to get 5. This would not be acceptable, right? Or would we say you just record 0 in the last 2 years? I think if you come to, year 2 or year 3 and you say, okay, now it's going to be 5.25 million, you'd have to do a cum catch and you'd reverse some revenue. So the 8.25, I think it makes it, View B makes it way more complicated than this has to be. But doing that and talking about the controls you have to put in place, you'd have to have constant controls, monitoring that 8.25, making sure that you don't go over the probable amount, because this sort of says that 8.25 is the entity's estimate, but it's the estimate less backing off. So they might have estimated 10, but now they only think it's probable of 8. Right? And then you have to keep truing this up, and if you do, in fact, get to a point where now revenues are going to be a lot less, you have a significant revenue reversal. You potentially have to defend why you overbooked the first 3 years. So am I thinking that right?
Yeah, I think
Because,
that's right.
I mean,
That's how the staff was thinking about it, is you would be subject to updating that estimate each reporting period and potentially having true-ups, especially when you're kind of within the bounds of the minimum guarantee. Once you're outside that minimum guarantee, you wouldn't be able to get ahead of your royalty. So you may not have the...
So some other folks said, well, I never exceeded the $5 million until year 3, so I'm never going to have a reversal of $5 million. But you would have to. If I change my estimate to $5 million, I got to do a cum catch, right? Or since I didn't exceed the 5, do I not have to do a cum catch?
The staff, we think you would. You'd have a cum catch. It'd be like if you took royalty out of the equation and you had an overtime, and all the consideration was variable, and every period you'd have to update where you are in a measure of progress, and if for some reason that variable amount got cut in half, you would end up with a revenue reversal. It's just a little unusual here in the situation because it's a arrangement that has royalty as part of the consideration.
Yeah.
Scott?
I thought this paper was very interesting, and it clarified for me that this is a Step 5 restriction, not a Step 3 restriction. With that clarified, frankly, I don't see how View C is acceptable. I think View C is what you get if you look at this as a restriction on estimating the transaction price. I think you get View C if you think that this is a Step 3 restriction. But with the clarification that it's Step 5, I don't see how your measure of progress is any good if you ignore the royalties above the minimum that you actually expect to get. It doesn't seem you're measuring progress appropriately if you ignore that and it's a Step 5 situation. So I was actually surprised, given the clarification that it's Step 5, that View C is even allowed. And I get that companies would like to use View C because you don't have to estimate then, and they thought that's what that paragraph said, that you don't have to worry about estimating. But if you tell me it's step 5, then I think you at least got to do some estimating to decide whether you're going to exceed the minimum or not. And then if you think it's probable you will, you got to recognize revenue using those estimates. So I'm surprised at the latitude the staff seems to think exists, given the conclusion that this is a step 5 matter.
The challenge in this fact pattern, at least to me, Scott, is so would you say for the very first dollar of sales that occurs, so you're still within the 5, but for the very first dollar, do you think that's fixed consideration or do you think that's a royalty? People have different views on that, particularly in a fact pattern where you expect to blow the minimum out of the water.
Mm-hmm.
And so if you say no, the bottom line is that is fixed consideration. No matter what happens, I am getting it. Some people say, well, that's fixed consideration. What's my measure of progress? Chug and plug. And then when I get to 5,000,001, that's when I start to have royalties. And because we have the recognition constraint,
but I don't think you could have a measure of progress that applies to fixed consideration and a different measure of progress that applies to variable.
you can't. But that's why this is...
That's why I think View C can't work if this is a step 5.
But don't you do a cum catch once you hit over the royalty?
What's that?
So the next dollar above the minimum would be...
You keep going. You'd recognize the royalty.
Right? To straight line it. It's a change in your transaction price.
That's not how we interpreted C.
Right. I don't think it is a change in your transaction price because we've concluded this isn't about estimating transaction price. That's my problem.
The way we've looked at View C is that I can see how you could look at it as 2 measures of progress, but we look at it as one, which is one measure of progress for the fixed consideration, and the variable consideration is allocated under the series recognition model. And so, that's where the distinction is. It's not 2 measures of progress. You have the fixed consideration, which, you would pick a measure of progress, and then the variable consideration is allocated using that series recognition model. So kind of taking 2 different pieces of the standard. And it's similar to other recognition patterns that we've seen in series types of contracts where there's fixed amounts.
Yeah, the recognition pattern you get in View C doesn't bother me at all. I just can't get to that if this restriction is a step 5 matter.
Russell?
Yeah, I had, I guess, a similar question, and maybe it is the series guidance that's complicating things a little bit. And after I read the paper, I had this question. Perhaps if I went back and read the paper thinking about this question, it would be clear. But let me just ask it anyway. The question of whether you're in the series guidance is not an option. Right, we've talked about that, I think, at the TRG, and that was one of the things that I kind of walked away with because we refer to the series guidance in some of these optional views of how you think about it, but it's not because it's not because the series guidance is optional. It's because the series guidance. Correct me if I'm stating this wrong, but it's because the series guidance doesn't necessarily dictate attribution. Maybe it informs it to some extent, but it doesn't necessarily dictate that you have an attribution pattern of X. It's really getting back to you have to use judgment in step 5 and how you do the attribution. Is that a fair way to say it? That's why the series guidance was kind of discussed here, but it wasn't because it's optional. It's because it doesn't necessarily dictate what your attribution is.
Part of the challenge with this question, and quite frankly, a lot of the questions that we'll discuss this morning, is we're getting into, in my view, questions where the facts are going to matter a lot, and yet we're trying to talk about this a little bit in the abstract. And so we're trying to do the best we can to provide some sort of general guidance, but none of this is going to supersede, none of this is going to remove a company's need to evaluate what's actually happening here. So as Mark said, we've put together a pretty straightforward example. The accounting's not necessarily straightforward, but we've put together an example where you estimated amount, it was way over the minimum, and lo and behold, every year you got exactly what you estimated. That, of course, is never actually going to happen. But there's no way for us to kind of take it beyond that, because we're just sort of talking in the abstract, and that's where I think the people around this table then kind of need to take it the next step of, well, what are the facts and circumstances, and how would I apply, particularly a measure of progress question, how would I apply the boundaries that Dan laid out to come up with a reasonable measure of progress? And I don't think the staff can take it too much further than that. So I think part of the, at least initial confusion you had was, I would like to be able to answer your question very directly, but without knowing the specific facts, it's kind of hard to do that. And you might look at your facts and say, well, this, view A you think is the right answer, but the person next to you might pick view C because they're looking at different facts.
Well, and frankly, I think we're at, in some of these examples, a level way lower than the board ever envisioned getting into in terms of prescribing methods. Now, that doesn't mean we don't need to consider the guideposts in the standard. I think that's what Dan said up front. But I've heard this issue being debated for the better part of 18 months with smart people saying view C is the only answer, or smart people saying with the same set of facts, view A is the only acceptable answer, or view B is the only acceptable answer. And I think, Scott, appreciating your point, I think we've heard people say, well, how could C not be the only answer? It's an application of what you do with variable consideration in a series, and saying, therefore, view C is the only acceptable answer. I think we were trying to say, no, that just like in accounting today, there will be cases where people will reach conclusions that a given attribution method is acceptable, notwithstanding the fact that someone else may conclude that they recognize pursuant to a different method of performance. Again, not that that's a free-for-all. And that's what we were trying to illustrate. If we're going to narrow this down to single methods that apply in all fact patterns, I think we would need, one, additional standard setting, and two, a lot more help identifying each and every one of those fact patterns. Marty?
Yeah, thanks, Jim. I just wanted to go back to a comment you had made earlier, then just track back to this. I think you had said that in this scenario, A, B, or C may be an acceptable accounting policy choice. Thus, my question is A, B, or C an acceptable policy choice for all usage-based royalties with minimum guarantees, or only kind of in the limited fact circumstances that you kind of had here?
The way I would think about it is it's an acceptable choice provided that you stay within all the guardrails. So if you had a circumstance where you had a minimum of $5 million, but you thought you'd only hit $4 million, then one of the guardrails that Dan has highlighted in the paper would probably mean that you're going to be in a UC type camp, because you don't really have royalties, you just have fixed consideration, and there's different ways you could recognize that, but over time, on a straight line basis, probably would be the right approach. But as long as a company stays within the guardrails that are in the standard and that Dan has highlighted, then the staff thinks you have an ability to make an accounting policy and meet all the disclosure requirements in 606, which require you to disclose information about your measure of progress. Yeah.
There's a number of cards up, so I'll just go around the table. Mark?
Speaking of 606, a question that occurred to me today, so forgive me, because otherwise I would have given you a heads up. Disclosure requirements, is there an implication of which one of these views that you decide on the remaining performance obligation disclosure? If you estimate the variable consideration associated with the royalty constraint, does that put you at risk of then having to not be able to make to take advantage of the optional scope out that we just agreed to? And I don't know if we've given that any thought, but if we have, fine, talk about it. If we haven't, we should think about that as we're writing up the other standard.
at least the way that's been drafted is that optional scope out is for when you're using, sorry, when you have a royalty and you're recognizing that royalty. So I may need to give it a little bit more thought, but I wasn't thinking this would impact that. And we'd also put in that fixed consideration should be disclosed. So the fixed component would be disclosed, but the royalty would not.
Mark, I hadn't thought about it, and I think it's a good thing to think about as we're finalizing those words. Is certainly to the extent that you're applying a method that requires you, like maybe B, to come up with that estimate, it sort of starts to blow out of water at least some of the basis that says you're not required to come up with an estimate for disclosure purposes that you're not already coming up with for recognition purposes, which is frankly, I think, why people have at least looked to some of the language in the basis to say view C must be supportable, because part of the basis was people can't make these estimates as it relates to sales and usage-based royalties. So I think it's something we ought to think about as we finalize, just personally.
But the way the board is articulating the choice for a company not to include certain amounts of revenue in that disclosure requirement is that we're linking it to specific parts of the model. So we're linking it to P times Q, to series, and to the royalties recognition constraint. So in my view, a company would have to say they're applying one of those to be able to decide not to disclose the amount. And I think all of the views that Dan has rely upon one of those. And so my view is a company would, notwithstanding the fact that they may decide to estimate, they would not have to make that. I see you smiling, but as we've worded it, I think that that's right. You know, as Allison pointed out in View A, yes, there's an estimation piece, but a company doesn't actually have to estimate it's going to be 8.25. They just have to estimate that they're comfortable it's going to be over 5.
Though it, again, seems like there, in selecting that policy, you might want to articulate how you got into that, is that you think that that it's you didn't estimate the whole, but you believe it's reasonable to conclude that you'll meet the threshold. Yeah. Although, I guess you're right, we did vote on having a sort of a principle for that disclosure, which said if you're not required to calculate it, then you don't need to disclose it. I could say I voted for that principle, but I was in a minority. Allison?
Yeah, I think where this conversation is going, and I had put my card up after Russell was talking, and now he's leaving the room, but that's okay. Not to call you out. I may not say anything that you... So it really depends on, again, what theory you think needs to be applied under the standard. If you're View A, you're thinking that, and I think companies would argue, because the series guidance is not optional, as Russell pointed out, that you're a series, you're trying to think about the appropriate measure of progress, P times Q, and the thought of using the output method for symbolic IP might be the way that a company would think the standard needs to be applied. If you get to View B, you're of the view that the royalties recognition constraint is only a recognition constraint, and that you still are permitted under the standard to make an estimate. You still have to apply the recognition guidance appropriately, but that's what View B would tell you, and that maybe there would be some disclosure implications coming from that. If you're in a View C camp, you're again thinking this is a series for symbolic IP, and that you are you're then required to apply the guidance in 32-40. Like, that is a requirement as well. It's not just that you have a series. Like, what we're finding with questions about the series is that they're going hand in hand. Every time we identify a series, whether it's in a license of intellectual property or in a service arrangement, or even for goods or services, the next question becomes, how are you applying paragraph 32-40 for allocating the variable consideration, meaning that they go hand in hand, which is why companies, there are some that are gravitating towards View C, and it's difficult, based on the words in the standard, to object to that view.
Brian?
Yeah, maybe to Allison's point earlier on View A, in paragraph 18, we're saying, well, you're applying a practical expedient, but then we're implying you need to do an estimate. which to me, the purpose of the practical expedient is based off the terms of the transaction, the amount I am billing or have a right to invoice is equal to value to the customer. And I think there was a prior TRG paper, one at the same meeting that we discussed the series, where there was a discussion of, if you make an upfront payment, then maybe you are not in the practical expedient, but the series guidance offers you some relief. So I guess I don't disagree with the outcomes of view A, B, and C, like based off these facts. They seem like reasonable applications of the standard. But I was a little concerned about telling people, well, even if you're applying the practical expedient in other circumstances, that you need to think about, you need to think about the whole contract, and is this somehow aligned with the total anticipated revenue from it? So to me, view A was really more view B, except you're just using an output-based measure of performance. On view C, that thinking back to that TRG meeting, I think in that one you had a series, and some of that discussion was, well, if you have a fixed payment, then maybe you can't apply the practical expedient, but you maybe can apply the series guidance. But in that, I think in that paper, the variable considerations start from day one. So it's like upfront payment, and then day one, every transaction has some variable consideration, and so you're allocating the variable consideration to that day in the series. To me, this is just like BC is just an expansion of that, saying, well, maybe it might take you 3 years to get that variable consideration, but when you receive it, it seems like it's attributable to all the value you have previously delivered to the customer, and that would be, hard to object to, although strikes me as a pretty significant expansion of the notions in that prior TRG paper.
So just to be clear, that the staff didn't actually come up with these views. I think you all did. We got a paper that I think outlined 6 views that people were debating whether or not the standard allowed, and I think we heard there were 7 or 8 other, or view number 7 or view number 8 actually didn't make that paper. And in some cases, the views got to identical answers, but different basis for why you would support your view. And so I think we were trying to limit this to 3 that we thought, at least in this fact pattern, might be reasonable ones. Again, each of those sort of had their own merits, and I think the problem was everyone was saying, well, my view sort of prevails, and I don't think the board ever got in. I wasn't here, but correct me if I'm wrong, board members, we never got down to that level of specificity with the interaction of the 2 pieces of guidance to provide sort of a single perspective as to how to deal with the interaction of fixed minimums where you have sales and usage-based royalties. Dylan, I know there's got to be one or more people on the phone that have been waiting very patiently.
Yes, Alan Cohen has a comment.
Yeah, hi. Thank you. So just to maybe respond a little bit to Scott's comments, and I get his point on view C. I think part of the issue, and to me, view C is more of a practicality type issue for a number of different reasons. One, the nature of a royalty constraint or the royalty constraint in putting it in place is because so many times you cannot estimate what the future revenue is going to be. And the example we have is so simplistic because it gives you the future revenue, even though it tells you you don't know this at the beginning of the contract. And I think a lot of times I'd say in our cases, most of the time you don't know what you're getting in the future. And so to try to estimate on thousands and thousands of contracts, I think would just be too difficult. And I think view C is a practical I would call it, way of applying the standard in this case. But I totally get what Scott's saying as far as obviously companies would like this. Of course, it's practical, but I think it also allows one to apply the standard in a reasonable way.
We'll just go back around the table the same way. Wes?
Maybe to jump beyond some of the discussion about the merits of A, B, or C, I would just go back to emphasizing a point that the staff has made, which is the paper is written in the context of a number of guardrails, a number of specific points that underlie the fact set. And in that respect, I'd connect it also to the description that the staff has on paragraph 30 about the disclosure obligations associated with describing the judgments that went into the selection of the methodologies and then laying out the application of that methodology in a disclosure context. I think that's an important element of the usefulness to users of the financial statements. For public companies, of course, there's also a disclosure obligation within MD&A regarding critical accounting policies. And so I think those are two important reference points that respecting the various views between A, B, and C disclosure here I think is important.
Scott. Oh, go ahead, Rita. We'll just.
Okay. Just to echo that point, I would be comfortable as a user. This would obviously create diversity in the comparability among companies, but I think it's better because it will reflect the economics of what's going on. And sometimes it is easy to estimate, and sometimes you really don't know at all. But to the point on disclosure, it's difficult to see how it could be complete enough to be useful, given many of these companies have thousands and thousands of contracts. So I don't know how you intend to try to present that, but every time I saw the requirements on the disclosure, I just shook my head saying, how in the world can that be? It just looks, I don't know if you have a framework for it or not, but it looks very difficult to get that part done.
And I don't know that, certainly I wonder what's done in practice today. I suspect there are people, maybe for differing reasons, because we have sort of different language in the new standard, but some iterations of things that look very close to each of these, and perhaps even broader recognition patterns today. I don't know. But I think we have a lot better guidance with respect to disclosure to at least help people with those judgments. Again, not that there aren't broad disclosure requirements today that perhaps people should have been thinking about as they selected recognition patterns for guaranteed minimums. In some cases, again, the diversity as wide as what we're seeing is potentially in this paper. Scott?
I certainly understand Alan's point. I mean, I think if this had been written as a practicability exception or something to ease transition, don't bother estimating if you don't want to, that'd be fine. I would get that, but that'd be back to the step 3 issue. And then just one more point with regards to view C, and I'm sorry we're belaboring this and beating up on this poor view, but if you took this example and you removed the minimum guarantee, you just didn't have one, then you recognize revenue based on your 5% royalty as it happens. Under View C, you add a minimum guarantee and slow down revenue recognition. Slower revenue when you're in a better position seems odd.
But you didn't know that when you started.
Didn't know, well, when you didn't know, if you got 2 contracts, one of which is 5% royalty with no minimum guarantee, and one of which is 5% royalty with a minimum guarantee, you would think that the one with a minimum guarantee should have revenue recognition at least as fast as the one without. But in fact, based on this example in View C, you get slower revenue recognition for the one with the minimum guarantee. I'm not sure we're doing a great job of reflecting economics if that's the case. Oh, of course you could change the facts. I'm just saying with this example.
If your royalties are low in the first year.
Absolutely. Absolutely. But it is unusual to be in that situation.
Russell?
So I'm glad I stuck around. So Allison's point that when you're in the series guidance that it sort of goes hand in hand with attribution and the application of 3240, maybe in fact patterns similar to this when you're dealing with intellectual property, maybe they typically do, but just to, as a reminder, the series guidance also applies to service contracts, and I think this is the point, Brian, correct me if I'm wrong, that you were trying to make, that you don't always have billings that are equal to or commensurate with the services as they're being performed. So it doesn't, 3240 doesn't always line up, and that doesn't always go hand in hand and dictate the attribution. So I think the snow removal example was a good example. When you're in a stand ready service contract, and even if you're in the series guidance, your attribution may be different.
Any other thoughts? Allison?
I was only going to say yes, Russell. I think 3240 you're required to assess it. You could, as Russell pointed out, and I think that's helpful. You could conclude after going through 3240 that you do not meet the variable consideration exception. And for licenses of IP, I think where people have gotten stuck is they're like, well, if the variable consideration is related to royalties that are being paid based on underlying sales and usage, there's really not many instances you can think of when you would not meet 32-40. But yes, for a regular service contract, you have to assess it. The requirement is to assess, but you may or may not meet those requirements. Yeah.
Others on the phone? Team in London?
No, nothing, Jim.
Okay. So I think minutes ought to reflect one, sort of the starting point of thinking about the, as you call them, Dan, the guardrails, articulating that, starting point would be making sure you're not out of line with those. I do think that the staff outlined at least a fact pattern where we thought there were, multiple acceptable views within that. I think articulating, I heard TRG members express concern about approach C and whether or not that is inconsistent with the single attribution requirement. I think articulating in the minutes a basis as to how we square that with that guidance and linking it to the series might be helpful in terms of addressing that concern. And I don't think it fully addresses Scott's concern, but just to be fair to your concern, Scott. No, but just to be fair to your concern, but I think articulating how we get there would be perhaps helpful in the minutes. And then I think important to capture in the minutes the disclosure obligations where there are judgments and policy choices. Any other thoughts on that issue? Perhaps we can take... Oh, I'm sorry.
Yeah, we have a second question on this issue for functional intellectual property. So a similar question on how does a minimum guarantee impact the recognition pattern for functional IP. The staff's view on this issue lines up with view A in the paper that a minimum guarantee for functional IP should be treated as fixed consideration and recognized at the point in time when the license transfers to the customer. The variable consideration, that is the royalties in excess of the fixed minimum, would be recognized in accordance with the royalties recognition constraint. This is because there is no uncertainty with regard to the guaranteed amount, unlike a royalty, which is uncertain prior to the point at which the customer's subsequent sales or usage occurs. And under the new standard, a performance obligation to transfer a license of functional IP is satisfied at a point in time. There is not a similar question about how the fixed and variable consideration affect the measure of progress for functional IP as was discussed in question 1 for symbolic IP. So with that view, I'll open this question up for discussion.
Brian.
Really having a lot of problems with this. Needs to be more heavily weighted or something. The one question I had is, I agree with the staff's analysis. However, I'm wondering, I think one thing that seems to be sort of missing is I think even though it's fixed consideration, it would still be subject to the constraint. So I'm thinking of a circumstance, for example, like if I'm a pharmaceutical company and some scientists maybe came up with some compound, but it's not really in my core, product portfolio. They go, oh, can we take the compound with us, form our own company, get a little VC money, and license it to us? We go, okay, and we structure it so that the fixed minimum is back end, like after FDA approval. We have many years to go before that happens. I guess I wouldn't, in that circumstance, go, well, just because it's a fixed minimum now, I get to recognize a bunch of revenue. I think I'd still apply the constraint, or might even conclude that I'm not sure collectability is probable at all, and I might not even have a contract in scope yet.
Yeah.
So,
Yeah, I think the fix would be subject to those factors, or maybe you may have even described a contingency that's out there. So you may need to constrain that amount because it's probable. It may not be probable. There's not going to be a reversal.
Yeah, so the point, I guess, wasn't just free pass on recording it. You have to think about all the other things that would apply to otherwise fixed. Otherwise, what you might describe as fixed, which could really meet the definition of not fixed.
Right.
This is not sales and usage-based variability, I guess.
That's right.
Allison.
So a question that I've heard on this, and just would like to bounce it off the staff to see if I'm thinking about it the right way. So questions have come up where, as back on the first issue when we were talking about symbolic IP, and in particular View A, where an entity would need to make a judgment as to whether they expected to exceed the minimum guarantee or not. There are some that have looked at this issue in issue 2 for functional IP and said, well, why aren't my expectations about whether I'm going to exceed the minimum or not relevant to the attribution of the revenue? And the way that I've thought through the distinction there is that in View A, or on issue 1, where we're talking about symbolic IP, the concept of measure of progress factors in, and so the minimum, determining whether you're exceeding the minimum or not may affect what measure of progress you think would be applicable, versus when we're talking about functional IP, there is no measure of progress concept. The timing of recognition is driven by the point in time when control transfers. And so that would be the distinction between the two. Does that sound appropriate?
Yes. Yeah, and in the symbolic, that kind of expectation, whether you expect to exceed, is really the basis for using that P times Q practical expedient. And it's along the same lines of the logic in TRG Memo 40 for just a standard P times Q arrangement with a fixed minimum. But we think because you really don't have a measure of progress in a functional, it's the day you deliver, that's your measure, that wouldn't apply.
If you're in functional, the board has decided that you have no further performance. So nothing to do about recognized revenue, unless the fixed isn't really fixed, as Brian said. But we're talking about fixed.
And just to clarify, I agree with this, and this is what we've been telling folks. I think the questions come up. The consequence of this is, if I have, say, a 5-year contract or functional license that I sell, then, and I say, it's royalties, but it's a minimum of $1 million a year for 5 years. Each of the 5 years, you would end up recognizing the $5 million immediately. And you would have sort of the back-ended every year royalties that would be recognized in the second and third quarter. So I mean, I don't know whether make that clear in here, but people are like, well, that doesn't make sense. I'm going to smooth all this. Well, you can't. What this is saying is you recognize the 5, and then as soon as you exceed the $1 million each year is when you start recognizing revenue again So, I mean, that's the consequence of this answer, right? Yep, yep.
And your point is because those become, if it is annual, those amounts over the annual threshold are going to become known and fixed at those points of time, which would tend to, in that fact pattern, be late, potentially, in the year. Yeah, depending on where the threshold is set. Other comments? Okay, well, now we can take a break. Let's try and come back, I guess, 20 after. Let's go ahead and get started on the third issue. The third issue deals with payments to customers, and as the paper points out, potential customers, I guess, in some fact patterns. Mary's going to take us through issue 3.
All right, thanks, Jim. Memo 59 discusses a question raised about accounting for upfront payments to customers. The question is about the timing of recognition of the payments in the income statement, such as whether upfront payments should be immediately recognized in the income statement, or rather recognized as assets and then subsequently amortized. And the question also relates to whether a payment that is recognized as an asset should be recognized and amortized in the income statement over the current contract term, or whether a longer period is appropriate in some cases, such as the current contract term plus renewal periods, or the period over which the payment is expected to provide benefit, or the customer relationship. Stakeholders have highlighted there is diversity in practice in this area today, and they question whether the guidance in Topic 606 will narrow that diversity, and whether the accounting results under Topic 606 could change compared to outcomes under current GAAP. In contemplating this question, it's important to note that during the development of the Joint Revenue Standard, the boards did not broadly reconsider the accounting for upfront payments to customers, except in the context of certain payments that may be accounted for as variable consideration. Much of the guidance on consideration payable to a customer included in Topic 606 is based on existing U.S. GAAP. Under current GAAP, accounting for payments to customers has been a challenging financial reporting issue for many years. Although current GAAP provides guidance on the income statement characterization, no explicit GAAP exists to determine whether the payment should be recognized as an asset or recognized in the income statement immediately. In the staff's view, an important first step in evaluating the accounting for an upfront payment to a customer is understanding the reasons for the payment, the rights and obligations resulting from the payment, the nature of the promise in the contract, and other relevant facts and circumstances. Understanding this rationale can be instructive when determining the accounting, and in particular, understanding whether and how the entity expects to obtain future benefits as a result of the payment. In addition, this rationale can be helpful in deciding what information about the arrangement should be disclosed in financial statements. The staff thinks that the accounting required by Topic 606 is clear in scenarios where the upfront payment is made to a customer and that payment relates entirely to goods or services in a current revenue contract. However, the staff is aware of two circumstances where the accounting may not be clear. First, an entity makes an upfront payment to a customer or a potential customer and does not have a revenue contract. That is, there is no contract yet to be accounted for under Topic 606. In this case, an entity might make an upfront payment to a customer and to a potential customer in anticipation of future purchases from that entity. The second scenario is where an entity makes an upfront payment to a customer and there is a revenue contract under Topic 606. However, the upfront payment relates to the current revenue contract as well as anticipated future revenue contracts. The staff is aware of two views about the timing of when the reduction in revenue for the upfront payment in these cases should be recorded. The differences in the views is differences in interpretations of the phrase related goods or services in paragraph 606.10.32.27, which is guidance on consideration payable to a customer. View A is that payments to customers should be recognized as a reduction of revenue as the related goods or services, that is, the expected total purchases resulting from the upfront payment, are transferred to the customer. The payment might be recorded in the income statement over a period that is longer than the current legally enforceable contract. Identification of the related goods or services will require judgment on the basis of the facts and circumstances. Any asset recorded under this view would be periodically assessed for recoverability. View B is that payments to customers should be recognized as a reduction of revenue from the existing contract. That is, it relates only to the existing enforceable rights and obligations. In the case where no revenue contract exists, then the entire payment would be immediately recognized in the income statement. The staff's view is that GAAP is not explicit in how to account for these scenarios under both existing GAAP or the new revenue standard, and that this has been a challenging issue for many years. In the staff's view, anytime an entity is making a payment to a customer or a potential customer in expectation of a revenue contract, the entity should carefully evaluate the nature of the payment. In assessing the accounting for these transactions, the staff understands that some stakeholders have concerns in situations where they would assert that companies are essentially buying future revenue by recording the income statement effect upfront, which results in the company reflecting higher revenue in later periods as they transfer goods or services. The staff thinks this would be a consideration when evaluating the appropriate accounting for these transactions. The staff thinks that aspects of both view and B have some merit, and in some cases, A and B may result in the same financial reporting outcome. The staff does not think that the selection of UA or B is an accounting policy election. Rather, the staff thinks an entity should understand the nature of the payment to the customer, understand the rights and obligations in the contract, evaluate the relevant facts and circumstances, apply guidance in Topic 606 on consideration of payable, and consider whether other GAAP is applicable, and apply professional judgment. In cases where the entity records the payment as an asset, entities should consider whether that payment meets the definition of an asset in the conceptual framework and assess recoverability of that asset in subsequent periods. So with that, I'll open it up to the TRG members for discussion.
Angela?
Thanks, and Mary, thanks for going through that and for putting this paper together. I appreciate it. We would be in the view A generally, and for really all the reasons that you put forth in the paper, which we thought nicely summarized the rationale behind view A. There were a couple of things that we noted in the paper that we wanted to comment on. You mentioned it in your summary about evaluating whether it meets the definition of an asset, and we just wanted to make sure that the fact that the payment might relate to anticipated contracts wouldn't somehow preclude being able to conclude you meet the definition of an asset. The way we were thinking about it is that, there's other cases like this morning, our discussion on commissions, where you could have an asset that relates to an anticipated contract. And in those cases, we're all comfortable that that's an asset, and I think you'd have a similar type analysis in this case, and wanted to see if you agreed with that.
Yep. So we've got the definition of the asset included in paragraph 34 of the paper, and that talks about probable future economic benefits. So we think that definition would include anticipated contracts.
Okay. And then my other observation is on the discussion of the impairment model in paragraph 36. And, I agree to your point about needing to make sure that the asset's recoverable when you've recorded it. But the paper talks about looking to other impairment models in GAAP. And I'm not sure we were really thinking about it that way, since we think about the payment as really a discount on revenue. So you'd be looking at whether you expect there to be enough revenue for the payment to offset, not looking at some other type of impairment model, like an intangible asset type impairment model.
Yep. So I think, what we tried to draw out in the paper is we don't think there's any spot in GAAP where this asset squarely fits. It's, do you have an asset? And I think once you have that determination, as with any other asset, you have to make sure that it still continues to meet the definition of the asset on its books. So I wouldn't say that there's any specific impairment model applies, but you have to assess whether it's going to be recoverable. So, for example, if all of a sudden the customer stops future orders and something happens with that customer where you don't anticipate future revenue, you'd want to reassess whether you should still have that asset on your books. So we're just talking about it in more broad strokes of, thinking about it in subsequent periods, not that you have to apply a specific prescribed impairment model.
Okay.
Mary, it's fair to say the board did not establish an impairment model in the standard for that. So those observations are equally applicable under current GAAP as they are under 606. I mean, I think the point is if you had something you were accounting for as an asset because it met the definition and it was customer related because of an upfront payment, you should have been thinking about impairment today. You should be thinking about impairment tomorrow.
Yeah, I absolutely agree with that. It just seemed like the paper was pointing you to try to find other models in GAAP to apply, which didn't make a lot of sense
In that, what you just said, Mary, you said, and you have it here and here, that the staff does not think that there's it's not a policy choice. There's either view A or view B. But in the examples and where you lay out sort of the views, like example 2A and example 2B, I would think that A is the only answer, but the way it's laid out here, do you guys have, since it's not a policy choice, I guess which one's the answer?
So, I mean, these examples are very overly simplified, so I don't think we'd want to get into in each one of these what, the answer would be. I think, when we look at the views, we couldn't necessarily say that one is wrong. We couldn't preclude view B in every single circumstance. So I think you have to look at the nature, why is the payment being made, and come up with, what you think is the appropriate accounting. And that's why we say it's not just a pick and choose. Either one could be the answer in either case. It's really what's the nature of why you made the payment. You must have had some expectation, you would think, of why economically you would give a customer money, and what is the rationale there, and what are you expecting to get out of this relationship, and then the accounting should follow on the economics.
And I understand there can be a lot more facts, but at least drawing this is pretty straightforward. I pay money, I expect parts. I would think view A is the answer. But expensing it immediately, like you state, is round tripping. So, if we're saying it's not a policy choice, then I want to make sure, because you say it's not a policy choice, but then we have these two views. If someone comes to us and says, I'm going to do view B in example 2, and they have that exact fact pattern, would we say that would not be okay? Or
so let me deal with how I think
I'm view A,
one ought to
and
think
I
about
think,
judgments. Is you can't say, well, all payments to all people for all time are always capitalized as assets, which I think is effectively view A. Without reason, I just have an accounting policy that says all payments to third party are assets. I think view B would go potentially the wrong direction and say all payments to all third parties for all reasons, irrespective of the contract, are always an expense. I think what the staff is saying, correct me if I'm wrong, is you need to carefully go through all of the facts in your arrangement and assess that relative to whether or not you meet the definition of an asset. Now, there may be cases in which exercising professional judgment, personal view, that two people can come to reasonable judgments on either side. That isn't to say it's an accounting policy election, but just like in any other profession, the medical profession, somebody has all of the facts and says, I think the best way to treat this ailment is A, and somebody else has all of the facts and says, I think the best way to treat this ailment is B. That doesn't mean there is always a single right answer to every set of judgments. I think the staff was saying, however, you can't default to the answer always being A or always being B.
Yeah, I didn't read A to say that you always capitalize, but if that's the read of A, then I agree. But I would think, in the facts, in the very simple fact pattern, which is pretty common, I pay an upfront fee to be on a platform, for example, on an automotive platform. They don't have to order anything. There's no contractual guaranteed revenues. They're optional purchases. You would capitalize that and amortize it over the expected purchases. Is that what the staff's view would be?
Look, I think barring no additional facts, I don't know why that wouldn't be. Again, you'd have to go through all of the facts in the arrangement, but if that same arrangement allowed you to capitalize a commission paid to the salesperson, then seemingly there must be a model under which, and I think the basis for conclusions talks about, the board thought those resulted in assets which justified the capitalization of the payments made to an internal person, why you would potentially reach a different conclusion with respect to that as it relates to a payment made to the customer that puts you in the same economic position.
And inversely, expensing it might be misleading. Because you're round-tripping revenue.
Allison.
I thought that a point that you made about how an entity thinks about incremental cost to obtain a contract, I think, is informative. As we were thinking through this, we were thinking to ourselves, well, we're saying that for some instances it would be appropriate to be deferring payroll, essentially, which is commission costs, but perhaps not deferring something where you were essentially buying future revenue, just to be kind of a little bit pejorative there. I think from our experience in what we would typically expect to see going forward, and I think you're right, you do have to go through the facts and circumstances just like with anything. I think it's pretty clear there's no defaults to anything in the standard, and judgment's going to be applied in all circumstances. But from an auditor's perspective, I think I would certainly approach fact patterns like this with a high degree of skepticism. If a company was making an upfront payment, especially one that's fairly significant, and if there was not something very, very precise that indicated that it was something that should be a period cost that would be expensed immediately, again, as an auditor, I would be skeptical of why you would not be capitalizing and amortizing that over the contract period or the period of expected renewals.
Brian?
Yeah, a couple of things maybe in support of my peers. I would just observe that View B, I only wish we had 606 and View B back when I was a software CFO. I would have never missed a quarter. And I would be rich beyond my wildest dreams, and I would not be at this meeting. But that wasn't GAAP back then. So I guess. Well,
just wait till the comment.
That's nice.
But we're sorry you're not rich beyond your wildest dreams.
So I would, I guess, in thinking about it in an individual fact circumstance, I would think of, you're making a payment to a potential customer. It seems like, why are you doing that? To get revenue from that customer. It would have to be some, unusual facts, like you're a flaky business person, you're a pie-in-the-sky internet startup, something like that, where I'd say, well, maybe that should be expensed. And then maybe second, in support of young Angela, it was asserted that the issue doesn't have an impairment model. I guess I would think that I would look there first for analogous impairment models, which all seem tied to revenue from that customer. And that if this deferral of this upfront payment is not recoverable from that customer, I'm not sure why I would go fish around for, it's a long-lived asset, or maybe I can come up with its fair value, or other models that are disconnected from the ASU.
Brian, I think that is a good point. It seems like these tend to occur in situations where it's more one-off, and that perhaps if you just gave $10 to everyone in all of a city, it'd be hard to distinguish that from perhaps advertising in terms of whether that creates an asset.
That's not to say that there are other things in the standard where you can take a portfolio approach, like, I give lots of porting credits or something like that. I don't know if I really would insist that, is that customer still here? It seems like it would be, susceptible to a portfolio type outlook. But again, I would be tying it to revenue from customers, not to broad entity-wide cash flows that have nothing to do with that particular customer.
Angela?
Yeah, so just a quick follow-up. I think some of the color that you added was helpful around how you would be thinking about View A and View B. I think when I read the paper, it felt more open to being able to get to a View B. So I think it would be helpful for the minutes to sort of reflect some of the discussion so that people don't use this paper as a reason to argue View B where it doesn't make sense.
Yeah, and I think we can do that. I think we also have to run the balance of not creating I think we can thread that needle of not creating a new accounting model, because I think part of the discussion is that we don't really think this model is different from the model that people ought to be thinking about in practice today. Again, we can clarify that. Maybe that would indicate that some folks have a problem in their accounting today if they aren't doing something closer to A, because again, I don't think we're creating a new accounting model through 606. With the limited, there is, I think the contract that is more clearly answered in 606 when it is directly related only to that revenue under that contract. Perhaps you have some very clear guidance now, other than just the broad definition of an asset. I think the staff draws out that fact pattern. Russell?
I think that's helpful to clarify, because my impression from reading the paper was that the staff just appreciated that there's existing guidance today and there's diversity in practice. So I think that's all you were trying to acknowledge. So I understand why it was written the way it was written. So the thing I think is so there is existing practice today, but the thing that I think is new as it relates to these types of arrangements is the idea of financing. And as I read, I just want to ask this question, because as I read the paper, I just want to make sure that were you intending to drop some breadcrumbs or imply that perhaps these things should be accounted for? Because I look at, for example, paragraph 15, where you talk about, you refer to it as an advance of funds to the customer, different phrases that would suggest that perhaps maybe this should be considered financing. And the sort of I think maybe Allison mentioned, you're paying for buying future revenues. That would kind of suggest that 8818 that there should be financing. But at the same time, there's also a lot of references to intangible assets, and so I could see a fact pattern. And in fact, we have some fact patterns where we view the transaction as a pay-to-play for the exclusive right to be the provider of a particular part for a period of time or for the life of a program. The counterparty may look at it as a sort of a reimbursement of some of their upfront costs that they have for developing, sort of setup costs and developing the program. So, when you buy an intangible asset, you typically don't think of it as a financing arrangement. So, I think that's probably a question that is new as it relates to 606.
Yeah, and that point on finance, that isn't anything that we were. I guess don't try to glean anything from the paper. Actually, it's the first I've heard of that question, so we weren't trying to lead to any conclusions there. I mean, I suppose, when you look at the definition of financing, it's when you have a significant, difference in timing between the payment and the goods or services. So, maybe it's a consideration, but not anything we had contemplated in context of this topic.
Okay, that's helpful.
Greg.
So, as the paper indicated, these types of payments are pretty prevalent in the IT outsourcing industry, and they do take on the nature of reimbursing the customer for out-of-pocket costs or pure pay-to-play. I want to win the bid versus the other guy who's not offering an upfront payment. So the view A is kind of how we think about these payments today and how we'll probably think about them tomorrow. And with respect to the discussion on how we look at impairment, it's always a customer-specific cash flow analysis, never a general or portfolio view.
Other comments, questions, concerns? Go ahead, Jim.
Jim, I just would emphasize the point that Angela made and Mark, to some extent, people reading the paper could say A or B could be the answer, but I think the point you made is you really got to look at all the facts and circumstances and making that conclusion. So whether it's in here and I missed it, or if the minutes can reflect that additional analysis, I think is very important.
That's a good point. Folks on the phone? Oh, Karen, sorry.
Just is there a concern at all that by having the minutes document more a view A perspective than a view B perspective, that we're, and maybe we're not, but that we're somehow changing the decision that the TRG reached in the last time it discussed this?
So I think, what we were trying to do with the paper that we try to clarify is we just didn't want to say view B is precluded in all cases. And I think the feedback I'm taking is maybe people viewed that it was more of a a level A and B, and I think the minutes is just to clarify what's in the paper, not necessarily to change any positions or any views. It's just to make sure that point comes through so that others who haven't been involved in these discussions don't get led astray.
Wes?
Jim, I'd reiterate and reinforce the comments that you made, which is it's not always A, it's not always B. There's a lot of judgment required in this instance. You talked about the importance of disclosure on the attribution paper that we worked through. I think it's important as well here, not only in the context of financial statement disclosures, but also in the context for public companies of our MD&A rules. I would also go back to sort of my earlier update in terms of the staff's activities. Some, I think, in approaching this issue have articulated the basis for either A or B as being based on prior staff experience of that might have suggested, a staff safe harbor or a staff default position. And much like we've rescinded our prior staff announcements for EITF issues in connection with the transition activities, we similarly would rescind those undocumented staff positions, whatever they may be, and instead focus on the importance of these judgments. One is being judgments and being decided in the context of existing guidance.
One of the things that we're certainly going to do after the standard is issued is take a look at practice as well, so that if it turns out that there are people in good faith going through all of their facts and circumstances and having very difficult calls about whether or not something is an asset or meets that definition, or whether it should be expensed, evaluating whether we need to take on future standard setting. Again, that would be in a fact pattern where people are reasonably disagreeing in good faith, and one of the things that will help us with that, I think, is the disclosure, so that we can actually see, yes, that, and again, I don't think this was necessarily a focus of 606, but it can tell us, hey, is there something more that we need to do to help resolve those issues? Others on the phone? In London?
No, thanks, Jim. Helpful discussion.
Thanks. Anything else on that one? Okay, let's move on to the fourth issue. I think issue that, as we said at the outset, has involved some level of technical inquiry. So I'll turn it over to Erica, who's going to walk us through that issue.
Thanks. Paper 56 addresses questions that the staff received regarding considerations for overtime revenue recognition under topic 606. There are 3 questions in the paper. I'll first tee up question 1, and then after that discussion, we'll move on to questions 2 and 3. Some stakeholders have posed a question that if the board's intention was an entity that recognizes revenue at a point in time under current GAAP may have to recognize revenue over time under the new revenue standard. Some stakeholders have asserted that this is an unintended consequence of the standard. However, the staff thinks that the outcome and the board's intention is clear in this area of the guidance. Question 1 addresses this concern. To provide some background, Step 5 requires that an entity recognize revenue when or as the entity satisfies a performance obligation. A performance obligation is satisfied by transferring a promised good or service that is an asset to the customer, and an asset is transferred when or as the customer obtains control of that asset. An entity should determine at contract inception whether it satisfies a performance obligation over time or at a point in time. Paragraph 606-10-25-27 provides the criteria for overtime. If any one of the criteria are met, an entity will recognize revenue over time. If none of the criteria are met, then an entity will recognize revenue at a point in time. The staff has received some inquiries from companies that currently recognize revenue at a point in time under current GAAP, but find that they are meeting the overtime criteria. For example, a contract manufacturer who is producing customized goods for a customer. In the staff's view, the answer is very clear. This was the board's intention, and an entity that recognizes revenue at a point in time under current GAAP may have to recognize revenue at an overtime under the new standard. In the staff's view, Topic 606 provides the necessary guidance an entity needs to determine whether they should recognize revenue over time or at a point in time. However, this topic is being presented at today's meeting because the staff is concerned about the aforementioned recent questions and comments, especially considering that the effective date of the standard is nearing and that a change from point in time to overtime could have a significant impact on an entity's revenue recognition. The staff wants to make sure that stakeholders are aware that they need to consider the criteria for overtime and that the revenue recognition pattern under 606 may change from what they're doing today. The board developed the criteria in paragraph 2527 because it thinks that an entity that satisfies a performance obligation over time should recognize revenue over time to reflect that the customer is obtaining control of that asset. In the staff's view, an entity that recognizes revenue at a point in time should not presume that it will recognize revenue at a point in time under 606. With that said, the staff is not implying that all entities that produce customized goods should conclude that they'll recognize revenue over time, but that an entity needs to perform an assessment of its specific facts and circumstances on the basis of the new guidance. For most entities, the staff thinks that this assessment should be straightforward and not time-consuming. Additionally, the staff thinks that when an entity performs this assessment, it would be an ideal time to consider the new disclosures required. Before turning to questions 2 and 3 about the criteria specifically in 2527C, I'll pause here to open up the discussion of the TRG members for question 1.
Thanks, Jim. Thank you. I think for issue 1, it is helpful, as you pointed out, Erica, to reiterate the point that there is no presumption, there is no default, that it's overtime versus point in time. Taking that even a step further, that it truly will, in many instances, be, for complex contracts, a contract-by-contract analysis, meaning that a company could have contracts with similar types of customers, but depending on the nature of the contract terms themselves, that could swing you from being point in time for one contract to overtime for another contract. I think it's helpful, and if people have different views about that, that would be helpful to express, but that's been the perspective that we have observed as we've been working with companies. The other thing I noticed that you'd mentioned that the staff thinks that most companies will find the assessment of whether you're overtime or point in time to be fairly straightforward. We're finding anything but that, to be honest with you, that the assessment of whether you're point in time or overtime is very complicated. In particular, and I think we'll talk about it a little bit when we get to 27C, just really evaluating what some of those contract terms really mean has proven to be fairly difficult. I'm hoping that once we work with companies and get them situated for the implementation, that on a go-forward basis, people will have a better understanding of how to structure their contracts or what have you. But just this initial transition phase, helping companies determine the point in time or overtime is truly, it is consuming quite a bit of time for companies as well as the auditors.
Allison, is that right to payment?
Right to payment is a big one. We've also been hearing just some questions around the interaction between 27B and 27C. Does one criteria override the other? Is 27B a default? Can that be a default or a rebuttable presumption? Just how wide should 27B be interpreted? So the questions are not so much 27A, but there are definitely some questions on 27B, and perhaps that's even more from an international perspective. But then 27C, it is right to payment, and I do have some comments to make when we get to that question in the paper.
Alternative use. Yeah, and some questions on alternative use. I would say that's raising some implementation questions as well.
Mark?
Yeah, just to add to Allison, we're having similar conversations, and I know I've had them with Allison and her team and the others on sort of how to interpret this, so it's not straightforward at all. It's not just the right to payment; it's the alternative use too. How much rework has to be done, and then the right to payment. But just to add on, I think what some companies are pushing back on us is this mixed model. And Allison said it has to be on a contract-by-contract basis. And we have a lot of companies, and almost all of them, have never really looked at what happens to the WIP if it's terminated. They clearly have a pretty good understanding what happens to their finished goods. They usually get paid for that. But they're like, well, we're silent on the WIP because there's not much WIP. And so we have companies that have gone out and done the analysis, and it's this rule is, they go to their lawyers, do we have right to payment? Well, you do in this one you don't. They get this mixed model, so they're running production lines with the exact, very similar products customized. Maybe, one's making a bottle for one company and another bottle they're customized. The WIP is small. They don't really care what happens in termination with the WIP, but it's extremely important here. You have to get your cost plus a margin, or you have to get, if you just get your cost, it's not going to be enough. So they have what is ending up being a mixed model, and it's extremely complicated to try to put in systems to basically almost identical contracts have different models. One, you'll have a warehouse with 70% of the goods you've already recognized the revenue, and 30% you haven't, but they're economically exactly the same. So that's the challenge that we're getting. So then they start pushing on the model, trying to get all their contracts into one or the other so that they don't have to deal with this. This paper sort of makes it sound like I've read it to not necessarily be on a contract. It's like, well, your accounting policy is this. Well, your accounting policy is you have to have right to payment or you don't. And so the mixed model is, and they're pushing back on us also about the users of the financials. Is this going to be what the users want to see? 70. We make two identical customized products, not identical, obviously, two customized products, and we have this. One of them we're recognizing revenue as we produce the finished goods, and one of them we're recognizing it as we deliver them to the customer. So that's a pushback we got, but I think this is helpful. I agree with the staff that it's if you're point in time today, you're definitely not necessarily point in time tomorrow.
And I wouldn't take anything in the paper to suggest that you do this across all contracts, that this is a contract-by-contract assessment. Brian?
Yeah, maybe just a corollary to like what Mark was talking about. I think this overtime notion, and especially condition C, is taking people time to wrap their head around it. Like in my own circumstance, we had a client that sold a customized good, and under today's GAAP, they were not recognizing revenue because it was on a bill and hold basis, and they didn't have a date certain to deliver. So they were all excited about the bill and hold guidance, and the 606 that now they were going to get to recognize revenue sooner. We pointed out to them, well, you're selling a customized good, and at least looking at the one contract you've shared with us, it seems like you have an enforceable right to payment. And the response from the engagement partner and client, yeah, we looked at that. We just didn't like that. So I think people are having a little trouble going, is that really what you're saying? And it's a learning process, no doubt.
Yeah, and I'll just add, in Erica's tee-up, she talked about it could have a significant effect, whether you're point in time or overtime. But we've talked to a number of companies through our technical inquiry process who have, had the same reaction of, we're point in time we don't necessarily like, or we're surprised by the overtime answer. But where you've got a very short production process or a very, short difference between when you finish the product and when you ship it, we like to point out that it doesn't necessarily mean that now you're on a cost input and you need a new ERP and a whole new system. There's judgment on what your measure of progress is, and you might be able to achieve the overtime accounting by a top side, especially where you've got very quick production process and short turnaround. So, although it could be a big change for at least a lot of the entities we've talked to, it's maybe not as significant as they originally thought when they thought, I'm moving from point in time to overtime. So we just point that out for those listening too.
So there the change would be finished goods versus when they, are either depending on shipping terms in the past. But I guess it would be a change for finished goods. But your point is they might not, if it's an instantaneous, sort of, you're making a can that is at the same time, imprinted with something that's specific, that there might not be a lot of WIP, or you could certainly shut down production so that at midnight, there's not a lot of whip.
Yeah, and there's probably ways to operationalize it.
Scott?
I was just going to second Mary's point about ways to operationalize this. I've talked to many companies who are surprised about this, and first they say, no, this can't be what they meant, and I tell them I'm pretty sure it's what they meant. This paper will clarify that. So, but then they say this is going to upend all of our production systems, and that's where I'm losing it. The advice I've been giving is you should do things exactly the same way as you have before, and at the end of the period, figure out what you've got in finished goods that is produced under the contracts where you get overtime, and make an adjustment to recognize the revenue. And the response is, oh, well, but the controls we would need around that. And I say, well, if your perpetual inventory system is that bad that you can't rely on it to make that adjustment, you probably had control problems before. It doesn't seem like this is the problem. Particularly for companies where WIP is small, it's really just an adjustment at the end of the period for finished goods. And if WIP is larger, then recognize you got to do something to deal with work in process. But I've been surprised at how hard some of the companies I've talked to believe it's going to be to implement this. I haven't been able to grasp why it would be so hard.
I can elaborate on that. If all your contracts are point in time, or all your contracts are overtime, I tend to agree. We've had those discussions with folks on how to operationalize this. When every contract's different, and we have a contract manufacturer, we have several contract manufacturer clients that have tens of thousands of contracts, and they got it runs through international locations, gets on boats and ships, and it's not as easy as just saying, well, these contracts or those contracts. Every contract could have a potentially different termination provision, and they don't focus on how much they get for their WIP a lot of times, because most of the contracts, if they're going to terminate, while they might be able to terminate in the middle and you only get your costs, they say, listen, we're going to stop using you. We'll give you 30, 40 days to run out the inventory. So they don't focus on that termination provision. Their contracts are economically exactly the same, whether they get reimbursed for their costs or they get reimbursed for their costs plus 2% or 3%. So it's bifurcating them. So I have a boat coming back from China, and what finished goods are mine or not, and it all hinges completely on this termination provision during WIP. They're all going to get paid the same for the finished good coming over, but they just don't exactly know what happens in WIP. So we're having discussions like, well, the termination provision says I get 30 days to run out my WIP. Well, you got to say, can I finish all the goods that are on hand at every point in time throughout my contract in 30 days? If you can answer yes, then you do. But maybe one contract that has the same 30 days, but you can't finish it in 30 days. You're going to have some WIP left over that you don't get paid for. So this rule needs to be done, like we just said, on a contract-by-contract basis. And unless all your contracts have the exact same termination provision, you could have different accounting, and then that's what you have to bifurcate them.
So it sounds like people know what to do.
I'm not arguing that they don't know what to do.
Okay. If it's a request.
I agree you got to analyze every contract. But once you do, I think your perpetual inventory system tells you which pieces of ending inventory are for which contract. So, upending your whole systems is what I keep hearing. That, essentially we need a new ERP system so that as the thing moves down the production line, we recognize revenue, and I don't think that you need to do that.
New ERPs, but I guess they're questioning, well, some of them are saying they need to do that. I guess we'll see what happens, but they're questioning whether or not this is what the users of the financial statements want. Only simply because of a non-substantive WIP termination provision, I'm getting completely different answers.
Right. And
that's what they question. Can they disclose? Can they disclose non-GAAP? I say no. You can't say that you have revenue that you don't, or don't have revenue that you do. So that's where it's getting.
Yeah, and that's all about, is it a good answer? Not what I've been surprised at. I'm not surprised when they say I don't like this answer. I'm surprised when they say, and it's going to be way too hard to do. It's the second part that I haven't been able to grasp.
Others on the first issue?
Okay. Questions 2 and 3 relate to the criteria in paragraph 2527C of no alternative use and enforceable right to payment. These criteria both need to exist for an entity to recognize revenue over time when evaluating that criteria C. The reasoning behind overtime recognition if an entity meets these criteria are as follows. If an entity is creating an asset that has no alternative use to an entity, the entity is effectively performing a service of constructing an asset that is custom to the customer. In this case, the entity would require economic protection from the risk of the customer terminating the contract. And if the entity in this case is getting paid, the customer has obtained control and is getting benefits from that performance completed to date and cannot avoid the obligation of paying. In turn, since the customer is required to pay, the customer is receiving the benefits, and this is why the entity should recognize revenue over time. In regards to question 2, stakeholders have raised a question about at which stage in production or manufacturing an entity should assess that an asset has no alternative use. For example, if an asset can be sold to a different customer throughout most of the production process, but the asset that exists at the end of the production process has no alternative use, does this asset have no alternative use when evaluating the criteria in 2527C? Said differently, stakeholders have asked if the timing of customization matters when assessing the criteria. In the staff's view, it is clear from the guidance and the board's basis for conclusions in Update 2014-09 that the assessment of no alternative use should be 1, performed at contract conception and should not be reassessed until a contract modification is agreed to, and 2, that an entity should consider the characteristics of the asset that will ultimately be transferred to the customer. In other words, an entity should assess the end product. When assessing if an asset has no alternative use to the entity, the staff thinks that an entity needs to consider both the effects of contractual restrictions, such as if an entity is not contractually permitted to use the asset in another customer's order, as well as practical limitations, such as if an entity would only be able to sell the asset to another customer at a significant loss. With this said, the staff wants to emphasize that just because the asset has no alternative use, the entity would not automatically be required to recognize revenue over time. This is because the entity must also meet the second half of the criteria in 2527C related to enforceable right to payment, which brings me to question 3. In regards to this last question, stakeholders have asked the staff to identify how and when an entity should determine whether it has an enforceable right to payment in accordance with the second criteria in 2527C. Topic 606 provides several factors that an entity should consider in their assessment. In the staff's view, the following are a few, but not the only factors that an entity should consider. 1, an entity should be entitled, to a reasonable profit margin on its performance completed. Excuse me. Apologies. If the contract is terminated by the customer for reasons other than the entity's failure to perform as promised. 2, sometimes an entity's right to payment for performance completed to date might not be, explicit in a contract, or it might be vague. Because of this, an entity should consider the contract terms as well as any legislation or legal precedent that could supplement or override those contractual terms. 3, if a customer terminates the contract without having a right to do so, and at that time the contractor laws give the entity to perform its obligation in accordance with the contract, for example, to complete its production process, to convert any products in production to completed projects, then the customer would be obligated to pay the promised good or service, pay the promised consideration, and the entity would have an enforceable right to payment in this situation. In the staff's view, Topic 606 provides a framework for an entity to determine whether it has an enforceable right to payment, but that application of the guidance sometimes will require judgment. For example, the determination of whether an entity is entitled to a reasonable profit margin on performance completed to date will be a matter of judgment. With that, I'll open it up for discussion of questions 2 and 3, and apologies.
Take a breath. Comments, questions?
I'm sorry. I'm not sure why it is. It seems like I'm going first all the time. I apologize for that.
We're glad somebody's willing to go first.
Okay. So my question, we talked about, and Mark brought up some of the interpretive questions that we are aware of related to how to think about the enforceable right to payment. In addition to those, since we've already talked about them, questions have been coming up, and I appreciate it's not necessarily directly within the scope of the paper, but around measures of progress. When you have a situation where you may have determined at contract inception that that the asset does not have alternative use, but that the enforceable right to payment may not arise until partway through the contract term. So, like if we were to look at example B in paragraph 21, in that scenario where we're talking about customized equipment, where the customization happens when you're 75% of the way into the contract, that's when the customization starts. Well, what if your enforceable right to payment really kicks in at that point because the customer, in effect, is really purchasing the customized asset? Maybe you could argue that's actually the performance obligation. So there have been questions around, when does revenue recognition start? Does it start at contract inception? Does it not start at contract inception? Some have also looked at paragraph 25-29 and have read in there's a sentence that says that you're looking at the enforceable right to payment as being something that happens at all times throughout the duration of the contract. So in a situation like what you see in example B, if the right to payment were not to arise until you're at that 75% of the way through the contract, does that mean because that right to payment doesn't exist for the entire duration of the contract that all of a sudden you don't meet the criteria, so you're point in time? Or could you interpret that sentence to say, well, what we're talking about here is really in the context of the entity's performance, and so you might also be thinking about not just the timing of when right to payment kicks in, but how that timing for the right to payment kicks in relation to what it is you are performing, or what is your performance obligation for the customer. And so those are a couple of questions. I appreciate this is not really a measure of progress paper, but when I read example B, that question jumped out at me.
And we've heard those questions on measure of progress, and as you point out, we didn't want to get into measure of progress in the paper, but we do think there is a linkage to, how you think about measure of progress will impact how you think about your right to payment. The standard talks about that you have to have right to payment for performance completed to date, so we view that as performance under the contract. So, if you don't have so if you're not counting something as measure of progress for recognizing revenue, you don't have to have right to payment for that. So, for example, you order some standard raw materials for the contract, but it could be directed to any contract. You're not going to include that, or we don't think you'd include that in your measure of progress. You don't have to have right to payment on those raw materials in order to meet the criteria. So there's some linkage there in terms of how you think about those two concepts.
Thank you. That's helpful.
Brian?
I just wanted to observe example C with the ice cream machine example. I mean, like Arca, I got choked up. I want to say, I love you guys, man.
Russell?
So we've thought about the question that Allison's raising, and I've had some conversations in the past with Mary about it. It seems as though, as we went through a lot of our contracts, the right to payment typically sort of aligns with the timing of when you start to customize the equipment, and it makes sense because up until that point, it's sort of, not to use alternative use because that confuses, but it's really it's fungible. It's really just your own inventory, and so that's how we've thought about it, and we have focused on the phrase that Mary mentioned, that that right to payment is in the context of performance to date. So it seems to line up. It does get a little confusing when you start to interject the idea of alternative use, because the way we really thought about it was, all right, let's say we had two companies that manufactured the same type of equipment, and one company was a point in time sort of a just-in-time, had a just-in-time inventory system. The other one actually would build to stock up to a certain point and then put them on a shelf. We didn't think that the answers for when those two companies should start revenue recognition should be different. In other words, we didn't think that signing a customer contract should generate a lot of revenue just because you've had the company that has the inventory on hand should be able to just assign the inventory to the contract and recognize a lot of revenue. So that's kind of how we ended up where we did.
other comments? People on the phone? Dylan, nothing? Mark?
I just, before we wrap this up, if I don't ask, I'll never know the answer, but I think I know the answer to this. And I run the risk of getting kicked in the shins by Hal and Mark over there. But, there was an exception in 81.1 for manufacturing of homogeneous products or, a continuous process, short-term type and duration. Is there any appetite for, because we got companies out there that just can't understand why they're getting rid of all their finished goods and all their WIP. Is there any appetite for that type of an exception and let those people just go to point in time if they so choose? I want to ask, it's probably towards Russ, whether you guys would even consider, for some of these companies, we have like a bottle manufacturer. They make bottles for companies, consumer product companies, and they're going to be in overtime. We got, people that make gaming systems for like companies. They're going to be in overtime. They can't understand it. So I would just throw it out there as a question if anyone would consider, and it would make our lives a lot easier too. We wouldn't have to deal with this right to payment stuff.
Scott?
I know the answer, so I guess silence is what I'm going to get.
You want me to keep
I just
them
asked,
now,
yeah.
That's why I just said Scott.
So I'm not going to answer Mark's question either. A couple of issues that I've been discussing with companies that get back to substance. There are various places in the standard where we say things that are implicit affect the contract as well. You can have implicit promised goods or services. Of course, some preparers are looking at those and trying to broadly apply it to other situations where you might be able to do the accounting based not exactly on what the contract says, but on how you think it would work in real life. So two that have been brought up to me in regards to this that I'm not sure whether they fly. I don't think they do, but one is situations where you have a right to payment upon termination, but it's a long-term customer relationship. You have many contracts with this customer, and you're not going to hold them to those provisions. If something happens and they terminate one contract, you're not going to risk the other contracts and other future business by holding them to these provisions. I have looked at that and said I think the basis for conclusion says you do this based on your rights, not based on what you might settle for. It seems to me that answers that question, but it keeps coming up when I'm talking to companies. And the other thing that I have seen on a number of occasions that actually surprised me is that the right to payment is clear for finished goods. For WIP, it seems like the contract is either silent or you just recover costs. Yet the process time is minimal, less than a day. And so I think they're torn between, they want to point to the contract and say, we only get cost recovery for work in process, ergo, we do not have a right to payment throughout the whole process, so we should stick with point in time. They like that result, but on the other hand, they also acknowledge that in reality, there would never be any WIP that anybody would care about. There would never be enough work in process that anybody would make any economic decisions based on it. So why should our conclusion as to point in time versus overtime be based on the fact that we don't have a right to recover for performance when that will always be a negligible amount that it would apply to? So I assume the staff has gotten these same kinds of questions. I think you have resolved we might not enforce the provisions one in the paper. I don't see discussion about evaluating the substance of the processing time.
Personally, on the first one, agree with you, Scott. There's a lot of things you might do in terms of customer accommodation later that could really not just call this into question, but you might be willing, if you didn't perform well on some other aspect of the contract, to give back amounts you collected from prior transactions, and all kinds of accommodations you might make to keep a good customer. I guess my reaction would be, if those contract provisions aren't the intended contract provisions, there is a way to deal with that, which is don't put them in your contract. And then I think so then it makes it easier. But I don't know on the second issue, Mary.
I mean, on the second issue, we've heard that, and I think, our view, and when we've discussed this previously, is that if you don't have a right to payment on WIP and you practically have no WIP, we don't think that lack of payment pushes you to point in time and preclude you from being overtime. I think you have to look at whenever you don't have right to payment on an aspect, you'd want to understand why. To link it back to the prior discussion we had on measure of progress, it might be because you don't have right to payment on it because it's not part of the performance on the contract yet, or you might not have right to payment because it's so immaterial or so, such a quick turnaround that it's essentially a non-substantive term. But that's going to require judgment. There's no bright lines there, but certainly a consideration.
Can you say that again? So if you
don't
have right to payment for your WIP, you could still meet the overtime criteria.
Well, if you don't have any WIP, or you can finish the point on the finishing the WIP is in the standard, and there is some judgment of whether you'll actually be able to finish it or not. But if you don't have you practically don't have any
that'll
WIP.
Push a lot of companies into overtime.
But I think your point, Mary, is
I don't think they think they're in overtime
if
with that.
If it goes from raw material to finished goods in some instantaneous process, linking that to what is your measure of progress, and saying, well, the reason the contract is silent is there was really no point in time at which I was at risk for WIP, saying that then turns the entire model for what you've said several times, Mark, is a non-substantive term in the contract. I don't think it was necessarily the intent to change the entire accounting over non-substantive term in the contract.
Yeah,
and you called it that several times.
I know. I agree. I agree 100% with what I said.
You'll be a terrible politician then, just terrible.
But I know there's a lot of company that aren't entitled to WIP. They're entitled to their finished good, and so now it's going to, if it turns in a day, they're in this model now, is what you're saying.
Yeah,
they don't think so. They don't think so.
I mean, the answers you gave are the ones that have felt right to me. But we did just say, and the reason I brought those two things up together, right? We just said that we're gonna look at your right to payment on termination for finished goods and tell you have to look at that. You can't say that's non-substantive because I would never enforce it. Yet this work in process term that could give you the other answer, we are going to tell you that might be non-substantive and you'd have to ignore it. So, it is, I think to some people it feels inconsistent, although like I said, I got to those same answers as you did. So hopefully there's some basis behind why we're going there. But, I am talking to companies that are feeling that people are being inconsistent and just interpreting the substance in whatever way forces them to go to overtime accounting, which, I don't think that's anybody's goal. So,
I don't necessarily think it was ignore the payment, but let's just say it was, producing cans, and the very last step of that was sort of the customization. So at every point in time up to that, you might be in have I really progressed toward completing of this, because I have a product to that point that could be used for anyone. And the last part of the process is stamping something in there that makes it such that there isn't a reasonable alternative use. Marrying that with what is your progress toward fulfilling your obligation to the customer might suggest not that you ignore what would happen, but there's no reasonable point in time at which there would be significant WIP in between.
Sure.
As opposed to how, and I don't think, Mary, you were trying to suggest how long that has to be.
Yeah,
is it simultaneous versus 2 minutes versus?
Right. That's of course the judgment issue that you get into, and we can't. There's no way to take that away.
Russell? Anyone else? On the phone? In London?
No, nothing to add here, Jim.
Erica, anything else on this?
That's all. Thanks.
Okay. So I think that concludes the discussion of the four papers. Did want to give TRG members an opportunity to raise any other issues that you might be contemplating. This is our last scheduled TRG meeting in terms of those which we've calendared dates for. Right now, our plan for 2017 is not necessarily to calendar potential dates, but we are not disbanding in any way the TRG. I think we've moved in to a phase where at least the volume of issues that's coming into the TRG has begun to decline. That doesn't mean that we don't want you to continue to send questions if you are struggling, but I think what we plan to do at this point is, if there are additional questions that come in, accumulate some number and then look for dates. That doesn't mean it has to be, 5 issues in order to convene a meeting. If there is one significant issue that people are struggling with, we can convene a meeting by phone. We would do that, though, to include the public. By doing that, as we'd certainly meet here so that we could broadcast it so the public has the opportunity to listen. But again, don't plan to schedule meetings until we have a sufficient volume of questions. There is one issue that we are continuing to pursue. It came out of the technical corrections project that the board had taken on, and this deals with the accounting for activities at the beginning of an arrangement. That was specifically tools, casts, and dies, in which the board concluded to convene preparers, auditors in a workshop format. We do intend to expand that discussion to include other upfront types of activities that you might characterize as sort of joint efforts, and we don't. That's loosely calling that sort of joint efforts or collaborating upfront at the beginning of an arrangement. And a number of issues that come up, an example of which is issues that are occurred in so-called non-reoccurring engineering. So at what point in time, and what do I do with payments that might be going back and forth? What do I do if I transfer control of some aspect of a contract to the person who's going to be the revenue provider? So there's a host of questions that have come up in practice. We're trying to get our arms around the population of those questions. And at least whether or not we can produce sort of a flow chart or a logic flow of how one might think about those issues. So we're going to expand that workshop to include those issues. If they impact you, feel free to reach out to Cullen and team. One, to let them know you might be interested in participating in a discussion, and two, if you've thought through the issues yourself or have a perspective on what the right questions to ask, at least as you've worked through it. Again, feel free to make sure our team's aware of that. With that, I'll open it up. Any questions, comments of the members?
Mike Wood, if you're still on the line, I know you sent me a note saying you wanted to make a general comment.
Yeah, and what I would just ask the board to think about is, we have early adopters in 2017, two of the companies I know of in the aerospace and defense industry have said publicly they're going to early adopt. What does the TRG papers and discussion really mean to them if in 2017 the TRG comes out with a view that's different than maybe they and their auditors have adopted? And, it's easy to think about how to implement an EITF issue or a FASB standard because it has a timeline on it. But none of the TRG discussions have a timeline or provide guidance in that manner.
Mike, I think that's a great question. I do think we need to think about the nature of education that might occur during 2017. But I think if you start with the starting point of, unless the board takes on a project to amend the standard is the standard. TRG discussions are intended to be illuminating. So, in some cases, that might have narrowed somebody's own view or thinking, but I think as we go forward, it certainly should be the case that we're not setting standards through the TRG discussion. Therefore, no need to address things like transition and effective date, but I think being very disciplined about that. That is, if somebody's come to a reasonable conclusion in their adoption, the TRG process should not preclude that reasoned and thoughtful position that is in accordance with the standard from moving forward. I guess the good news is if people are elevating those issues that are the difficult judgments through their own process, there's certainly then preparers around the table that sort of have a voice to help articulate that. And the good news is for most public companies anywhere, their auditor is represented around this table. So if they're being elevated internally through their audit network, somebody at this table ought to be able to then express sort of the reasonableness of that position that was taken as well if the discussion started to go a different way. I also think it is why we ought to be judicious in 2017 about the nature of the discussions that we might have. That is, hopefully, if people have been diligent, they've already been surfacing the issues to us, which is why I do think scheduling meetings formally into 2017 would signal the wrong message. People ought to be able to adopt with confidence at this point. Any other board members with a sort of different perspective? Scott.
I don't see any on the issue tracker, but maybe you've been handling through technical inquiries if they come in. Have you gotten questions on disclosures? Because I don't think we've really addressed any here other than the matters that are in the technical corrections project. But I'm starting, happily, to get some questions on disclosures, and I don't know if the staff has been getting those already.
We have been getting some questions on disclosures, particularly from those companies that are very far along and plan to early adopt. Most of the questions, other than the disclosure Mark already mentioned on remaining performance obligation, other than that one, I think they've mostly been questions around how do I apply a particular disclosure requirement when I know that it will require judgment to do so. And so, for instance, one of the disclosure requirements is that an entity should disclose information that helps bridge disaggregated revenue disclosures to segments or reportable segment disclosures. And the standard doesn't say that, thou shalt create a reconciliation between the two. However, in the illustrative examples, it does provide an example of how one could comply with that, and it so happens that the example is, in fact, a reconciliation. So the question was sort of confirming, did the board actually mean that we had to do that, or was that merely an example of how one would comply? And the staff view on that is no, the standard doesn't say that, and so you have flexibility on that. The important thing is to make sure you've disclosed something that is actually useful to an investor so that they can understand the difference between what you've disclosed for disaggregated revenue and what you've disclosed for segments. We've also heard a few questions to help understand the relationship between the two. And the example that the boards chose to provide is just one way that someone could decide to communicate that information to an investor. We've also received questions of a similar vein, but questions around some of the specific requirements for changes in contract assets and contract liabilities. One of the disclosure requirements in particular about what we call as the staff out-of-period revenue, so a circumstance in which you have performed in a prior period and yet you're recognizing revenue in the current period. For example, because you have variable consideration and in the current period some additional revenue came through the constraint and yet you had performed in a prior period. At I think it was our last revenue board meeting where we talked about technical corrections and improvements, The board decided to relocate that particular requirement, so we didn't change the requirement. We just decided to relocate it because we thought there was some who didn't understand that that requirement was in the standard based on where it happened to be included. And so the board decided to move the location of that particular requirement to make it clear that the out-of-period revenue is about any out-of-period revenue. It doesn't matter whether you happen to have a contract asset or a contract liability. Also within those disclosure requirements, the board, or at least some board members, were early on in the history of the project were interested in asking a preparer to provide a roll forward of contract assets and contract liabilities. And ultimately, the boards decided that a roll forward would not be required. Instead, the board identified a few pieces of information that they thought would be essentially components of a roll forward that they thought would be, in the absence of a full roll forward, would provide investors with the information that they need. A few preparers have asked some specific questions about those, how we articulated those components. And the staff has given them a view along the lines of, well, you do have the ability, those are requirements to explain differences between your contract assets and your contract liabilities, but you do have, some degree of judgment in exactly how you decide to comply with that. For instance, one company that we had talked to, a month ago or so, had said, well, in their circumstance, they actually already disclose a roll forward of what they refer to as deferred revenue. Would I be able to disclose a deferred revenue balance, or would I be able to, a roll forward of my deferred revenue, or would I be able to provide the components of that for each quarter? So in their annual report that show this is what happened in Q1, this is what happened in Q2, and the staff view on that was, yeah, you have some judgment. You can't ignore the disclosure requirement. The boards are clearly looking for people to provide information about changes in your contract assets and your contract liability balances. But if you have a circumstance where you actually want to provide more, you want to provide a full-blown roll forward, or you want to provide the information for each and every quarter separately, the staff view was we viewed that as more than the minimum, and so we didn't know why that would be precluded.
That was a lot there. On that last one, I've talked to a couple of companies about that as well. Would a roll forward, a full roll forward of contract asset, contract liability might not have the specific components that are required in the disclosure actually broken out, because they might be subsumed into larger numbers. Some companies, if they run everything, if their business is such that everything runs through the deferred revenue account, because they always get paid in advance, then when they actually recognize the revenue, they might not identify whether it came from deferred revenue that existed at the beginning of the period or was added during the period. And my initial advice was, well, providing the roll forward without breaking out that component that's required might be a problem. I think, were you saying that the roll forward would be sufficient? Certainly it would be allowed. I understand that.
Seemed like in some cases that might actually be grossing things up as opposed, and therefore providing potentially more information as opposed to what the standard might be talking about, which is netting down if I sign a contract on. And so we were struggling with why saying providing a gross amount of information might be sort of, if you looked at meeting the disclosure objective, why we would say, no, it's actually worse to provide the gross versus the skinny down. So we were less troubled by that. But
I have a phone call to make.
And the other one I think Cullen was might have been referring to is sort of if you call it the out of period revenue number. If you think about an amount that you receive in Q2 associated with a Q1 contract, let's say performance was complete, it would be out of period for Q2.
Yeah.
But in period for year to date or in period for annual, that we thought it might be acceptable to actually just do that each quarter. So you have Q1, here is the amount, Q2, as opposed to doing both a quarter and a year to date, such that in your annual financial statements you might have the 4 quarters as opposed to at each point in time saying you must both do quarter and year to date. We didn't think the standard necessarily precluded that. We didn't. Again, I don't think somebody would be precluded from doing both, but we thought just doing the Q to date might also be acceptable.
Colin, or Jim, where will that be documented? Will that be part of the TRG minutes now?
Whoops. I think people just heard it.
But not everyone is listening today, so just in case.
I know, one thing I know is that this is an issue that, at least the first time I heard it was a CCR meeting, so I know there's a lot of companies that are aware of this issue. I think there's a small subset that are far enough along to be parsing individual words in the disclosure requirements, but I think, at least for public companies, the word has started to get out on this. I think we can think about whether there's anything we want to say in the minutes. We don't actually we didn't actually have a TRG paper for you all to react to, so it may not be fair to put it in the minutes. I guess we can think about that. But from the staff's perspective, I think a key message is those companies that are really far along have realized that there's a lot to think about on disclosures, and they're needing to spend time to make sure they understood what the boards had intended. And so I think that's a good reason why it's important to get started, particularly on or including the disclosure issues. And also, if you have, this is going to be a judgment that a company makes and its auditor makes, but if you have a circumstance where you think there's information to disclose that would meet the minimum, meet the spirit, but it goes beyond that, I'm unsure why a company and its auditor would be uncomfortable with a company disclosing something that's beyond what you think is kind of the bare minimum disclosure requirement.
And Scott, I think that probably the harder one is the first one about the roll forward. The staff did reach out to each of the board members, including, importantly, our two user board members who would have preferred requiring the roll forward for all. So I think it was sort of stepping back and thinking about, have you met the broader objective of the disclosure requirements, as opposed to thinking of it as a minimum set of checklists. Now, that's obviously a very difficult judgment. People have struggled with that, including a big aspect of our disclosure effectiveness project is, when can I think about having met an objective versus an individual criteria. But I think, and obviously can't speak for all of the board members, but the sense I got back through the staff was that a full-blown roll forward in most cases would provide that information. Mark?
Yeah, so at least the way I thought about it was the basis for not requiring the full roll forward was to require the most important pieces of the roll forward without incurring all the costs of tying it out to the penny. And so if a company, instead of doing the minimum amount that's required, decides it would be better to do the whole roll forward, it's hard to sort of suggest that wouldn't be better information, in fact, than just the piece.
Other comments, questions? Well, I want to reiterate the staff's thanks to the TRG. At the outset, you have been and continue to be an excellent resource, both in identifying issues and providing a reasonable perspective to those issues. I encourage you to continue to keep us involved as you identify issues that people are struggling with. And again, thank you. And if we convene another meeting, we'll search for dates. Take care.